Hello everyone, good afternoon and welcome to day 2 of this refresher course on Companies Act, a very critical one as we are in midst of revised reporting standard, revised reporting requirements, and most importantly the CARO guidelines. Today, first of all, at the outset, uh, let me express my heartfelt gratitude to each and every one of you for joining us again. Yesterday we had a wonderful session. We've got super feedback about both the speakers yesterday. Going on next today, I'm sure will be not be an exception. We'll have a wonderful session because CARO is something that we all have to now worry and focus about. One of the important things that comes up is fraud requirements, reporting of fraud and all of this. So I think that will be a very critical one. Let me also wish greetings of Mahesh Navami to all the participants, to all the audience here. It's a proud day for me individually, being from that community. So yes, and today I welcome the faculty, CA Viral Shah, an expert faculty who I'm sure these 1.5 hours would be less for him to deliberate on this very important topic of CARO, but I'm sure he will try and fit as much as possible. And based on your feedback, what we can do is we will try and get more, maybe one more session only on CARO. I also welcome both the coordinators, CA Bhavna Maheshwari and CA Sanket Kalandri. Let's quickly begin this. I'll request CA Bhavna to please introduce our faculty for today.
Yeah, sure. Thank you, Arpit sir. So I'm first of all, I would like to thank and give me this opportunity to welcome Viral Shah sir, who is an eminent faculty, and he has been majorly known for his vast experience in banking and financial sector, and also sir has been an eminent personality with explicit experience in with various industries. However, his focus was into banking sector, and he has cleared his CA in 2001, and now presently he is with us with a 21 year of experience, including his work experience with corporates for 12 years, which is a lot. And sir is presently the partner of the VC Shah and Company. Also, sir has worked with for 7 years. He has worked with Deutsche Bank. He has also worked with nice financial institutions as JM, Morgan and Stanley, ICICI Bank, Home Finance, and sir has also been into product controlling, product roles, and he has also been advising on accounting and derivatives. Sir has a vast experience majorly into financial sector, and also sir has a huge experience into audit and assurance. He has worked on statutory audits with various general insurance and private companies. He has also worked with sugar manufacturing companies. So that way, sir has a vast experience with varied industries. So, sir, so for today's topic, we have a very interesting topic, and since we recognize you as the expert in that field, we welcome you to throw light on auditor's report due to amendments in the Companies Act and amendments in CARO.
Thank you, Bhavna. I can understand, with the kind of profile that he has, to summarize it in quick minutes is really difficult. So well done. Well done there. And welcome, Viral Bhai. Over to you.
Thanks.
Participants,
Thanks,
before we could start, participants, you can please post your questions. Bhavna and Sanket would be compiling all of them and would take up in the end of the session. Have a happy learning. Thank you. Over to you, Viral Bhai.
Yeah. Thanks, Bhavna, and thanks, Arpit. So I'll take it from here. And as Arpit rightly said, probably the profile is little weird in terms of our profession, where I was working with industry and come back. So naturally, there will be some difference. But yeah, I will try, and I won't consider as an expert because since this is the first time of CARO for all of us, we all are in a learning phase. But yeah, definitely some bit of application of CARO which has already been done. I'll try and help the entire forum today to share my experience so that we all become some way expert. So coming to my presentation, is my presentation visible to everyone? Arpit, it's visible?
Yes, absolutely, sir. Absolutely. We are on the first page with your details.
All right. Okay. So I have to just. So this is the table of content. These are the broad areas and topics which I am going to touch upon today. So which is background, why there is a need of CARO 2020, which my perception, applicability as of today, the overview of the CARO 2020. Then I have summarizes the clauses of the CARO, where the different categorization of the clauses have been done. Then detailing of the CAROs which are newly introduced in the current CARO 2020. Some points and tips to remember while performing this applicability of the CARO, some auditing procedures which are required for during the audit, and probably the necessary documentation. I think these are the gist. So if I may say and summarize, this CARO itself has become a special audit. Apart from the audit, this CARO is as an additional audit which has come up on the entire profession which you need to perform. So let's take it further. We all know that this CARO 2020 was applicable by way of a notification from MCA, which was originally applicable from 1/4/20, which was postponed by a year. So now it is applicable to all the companies, and there are certain exceptions which I will discuss in the subsequent slide. But it is applicable from 1st April 2021. So any auditor's report come after 2021, this CARO is applicable. There is no change per se, but there is a new introduction in the CARO which has happened for CFS. Erstwhile, there was no CARO applicable to consolidated financial statement, but in the current year, from CARO 2020, there is a reporting if there is any negative or qualified report given in the subsidiary or component audits. CARO 2020, a brief summary is it has increased a lot, as I mentioned, the reporting requirement for us as an auditor, since we are attesting the financial statement, and greater onus on the auditors to report many of the aspects which are financial, non-financials, ownership related, so and so forth. So this is all about the CARO 2020 background. Moving on, it's my personal perception and view why there is a need of CARO 2020. If I just step back, if we see that the CARO originally was something called a Mao CARO, which was in 1980s, 90s. Then it was amended in 2003. Again, after 2003, it got amended in 2016, and now in 2020. So if you see the horizon of the longevity of CARO sustainability has reduced. In 4 years' time, this CARO is required to be changed. My view, why it is changes, there is a lot of spikes have happened in the recent years of the fraud which has happened, and all the eyes of the frauds are on the financial statement of the company. So the onus has gone on the auditors, where they are supposed to report certain instances. To this fraud which is detected is on account of fund diversion, on account of the unaccounted cash or misappropriation of the inventory, so and so forth. Third, there is a lot of focus by the regulators which has come on the organizations. The regulators being SEBI, RBI, NFRA, SFIO, MCA, so and so forth, where they wanted the auditor of the organization should be more vigilant and giving more reporting on their auditor's report. Fourth is, if we see, there is a lot of increased responsibility also has gone on the senior management, board of directors, and so the auditors. So I would see that is also one of the requirement where they have covered many of the clauses, which is directly, asking the management about the compliances and the auditors to, report in their auditor's report. So these are my few, and of course, one last but not least, we have seen also there are some auditors' resignation. And these resignations also, they wanted the compliances point of view to be reported in the auditor's report. So if I am the auditor today appointed and it is on account of the resignation, we are supposed to report in our report. So these are few instances which I feel is necessitated for need of this CARO 2020 which has come up. CARO 2020 is applicable to all the corporates, all the entities, but there are exceptions. These are the exceptions where it is not applicable to banking company under Banking Regulation Act. It is not applicable to insurance company under Insurance Act. It is not applicable to under Section 8 of the Companies Act, OPC as per the Companies Act, small companies as per Section 285. For private limited company, there is a criteria which is given. So it is not per se not applicable. It is applicable to only those which are subsidiary or they are holding of the public limited company, then it is applicable. But it is not applicable if these three conditions, where the net worth, I would say, is less than 1 crore, or the total borrowing is less than 1 crore, or their total revenue is less than 10 crore, then it is not applicable. Otherwise, it is applicable to all. So to larger audience, probably if it is a private limited entity, then yes, there would be a little relief. But if it is per se falling in any of the category which are subsidiary of the public limited company, or private limited company itself is a holding company where some subsidiary is a public company, then CARO is applicable. So as Arpit earlier mentioned, if anyone has a question, please post it and I will, reply any of the question at the end of the session or in between interactive if we are open to do that. I have tried to summarize this entire table. So not to read this, but this table gives you each clauses. The fonts which are in red are the modification of the existing clauses. There are fonts which are completely black. Probably there are new clauses which is incorporated, or there are no changes at all. So the entire table is summarized into three portions. One is the modified clauses, one is the new clauses which is added in the current period, and there are absolutely no change compared to the 2016. So all the slides I will skip right now because I have covered that in detail, but just for the readability of the audience or anybody wants to refer in future, they can do that. So this is the summary which is important. There are 21 clauses in CARO. These 21 clauses are into three buckets, 777. There are completely new clauses, 7 new clauses, 7 modified clauses, and 7 clauses which are retained from 2016. And from 2016, one clause which was completely deleted is managerial remuneration. So this is the summary of the entire CARO 2020. Now I'll move on for each point by point CARO, and this will be very important for me to take you through. I have not covered right now the clauses which are completely same compared to 2016. I have touched upon only those where there is a modification or there is a change. So if you see the structure of my slide is, each slide I have mentioned the clause which is the bare clause from the notification. I have mentioned whether it is a modification or a change or a new clause. And I put my consideration or a concern which I feel is important for all of us to know. So first clause, this first clause, the agenda, the first clause talks about the property, plant and equipment, where the company is maintaining proper records, and this records requires the full particular of the PPE. So earlier the clause mentioned about fixed assets. Now that fixed asset word is replaced with PPE, which is in line with Ind AS and the AS10. What is required is full particulars. So I would urge each and every participant right now, we should go through even the guidance note institute by institute, wherein the detailing of each and every clause has been given for the auditing procedure. But I will just touch upon what exactly the key highlights of the points. So first is the full particulars. Now when we say full particulars, there is no such definition of full particulars, but we all know about the requirement of the place, the nature, the vendor name, the period, all kind of information should be there, where the location of this, the date of put to use, everything should be there in the fixed asset register. So it is very, very imperative for the auditor to mention whether the full particulars are there in the fixed asset register or no. If not, then they have to qualify. Second is the new inclusion. I would put it that even they have added is the full particulars of intangible assets. Now, intangible assets can be of two types. It could be acquired intangible assets or it could be self-generated. It should be properly bifurcated in the fixed asset register about the intangible assets and the details of the same way full particulars should be there in the fixed asset register. So these are the two clauses which are modified in the current. Clause number 3(1)(b), which talks about the physical verification. Now this was there earlier. This physical verification was mandatory. It is good for the management to do this. Why? Because at the end of it, the asset should be protected. There has to be a process under which the management should have a periodical verification policy, and the auditor should see the periodical verification and see the output of the verification. Many people, they do the outsource of this physical verification and they come up with the report. Auditor's responsibility on this is to come up with the discrepancy and account for the discrepancy. Now you may find there is a concept called a ghost assets. When I say ghost assets, means the asset is there in the physical register, but physically it is not there. And there may be a criteria where vice versa it may be possible, where the asset is there, but it is not there in the fixed asset register. Both the instances, it's alluding to a misrepresentation of the financial statement. It needs to be properly dealt with in the books of accounts. So what are the requirement to dealt with in the books of accounts is, in consonance with the management, we have to either account for those assets which are not there in the fixed asset register, maybe with a very minimal value, so that we know the quantity of the fixed assets which we have, I mean the PPE. And if it is the vice versa, then we need to do a write-off if it is required with the proper approval. Of course, the subjectivity of the materiality should be kept in mind, but this is the need of the clause. 3(1)(c), which talks about whether any of the immovable properties which the company has, other than the properties where the company is a lessee, are disclosed in the financial statement and are held in the name of the company. Now, this is the clause which talks about any immovable property which is lying in the fixed asset register, which is there with the books of account. It should be in the names of the company. Now, so I have written as a concern here, because what is most important is the immovable property should be in the name. In many organizations, if you see, these properties are lying in the books for maybe 20, 30, 40 years. It may be fixed asset, which is land, which is building, and the papers are lying somewhere in some offices, which is in Delhi or which is in Calcutta or any part of the country. So what is most important for us is to get those papers to see whether there is in the name of the company. My experience, I have seen where it is possible that the original property was bought in XYZ company, then there was a merger which has happened, or there is a demerger which has happened. The original name of the company in the paper remains the same of the old company. Now, it is very important for us to report this, that if such instances have happened, the name of the companies have changed. So in this scenario, we are supposed to report stating that originally the company was, the property was bought in this X company. Now it has been moved to Y company on account of this activity of amalgamation or merger or whatever, and then we have to qualify that. So it is very important that the name of the property should be, the ownership should be in the name of the company. And that is the huge reconciliation which we need to perform along with the management. Management need to assimilate all the information for the auditors, put it in the PPE register rightfully and give it to us. So hence I said it's a concern that how do we get this information, because all this information is not readily available. Some of the property papers are lying with the promoter, some of the property papers are lying with some custody, which could be any trustee companies and all. We need a certificate from them. So these are certain pointers which I can share with you, where we have to deep dive, ask the management about all the papers which we need to verify, and then come up with the reporting for the right reporting. And why this is introduced, because all this immovable property, if they are not in the name of the company, then tomorrow it will be prone to any legal battle, and it may create any liability on the company. So it is very, very good and imperative point in the current CARO that if these things have come up, and why I tell you, probably I feel why it is come up, because if you see, a lot of cases are happening in NCLT these days, a lot of litigations are happening. Probably these are another thing, that the company ownership is in the different name, but still lying in the books. How can that be? So probably this is the way where all these such cases may come up, unearth, and probably it will do the corrective actions where it is required. So I'm not saying the ownership is wrong, but probably if ownership is not in the right name, then it will create a litigations and the company will have to get into a different battle. So from that perspective, this clause is very, very important. There is a table which is given how exactly we are supposed to report if we see any deviation from the name of the company. And this is the table which you need to see. Point number 31D, it is a new clause which is added in the current year, that as per Ind AS or even in AS also, the revaluation is permitted. Now, if the management is of the view that they should do a revaluation, then if the value of any particular class of asset is more than 10%, then where we are supposed to report here in the audit report. The key consideration here is the valuation to be carried out for the entire class of assets and not for any particular single asset of that class. So if you are doing for property, then all the property needs to be covered. If you are doing for machinery, then entire machinery needs to be covered. And two is any deviation more than 10%, only then we need to report here as a change in the value of the asset. I move on clause 31E. It is a new subclause added. This talks about whether any proceedings have been initiated or are pending against the company for holding any Benami property. Now here the requirement is come up where there are a lot of litigations comes up and the allegations have been put on the company for holding any Benami property. If during our audit, how exactly we are supposed to, the question is, if the company is, the property is not in the name of the company, how will the auditor identify whether it's our property or not? So what is required is to first is discussion with the management, the legal department, or any of the I would say the complaints or any of the notices which has come in the name of the company for any of the property. So this clause requires an appropriate disclosure in the financial statement for any proceedings which has happened or initiated. What is required as a disclosure is which kind of a nature of the property on which the allegation has been put, what is the carrying value which has been claimed by the person under the Benami Act, and the third is what is the consequential impact. Will that be a financial impact or it is just a liability which you need to create? So these are the three clauses which you need to assess while finalizing the audit and also appropriately report in our statement, in our report. In case of proceedings are initiated post balance sheet, then what to do? Then also we are supposed to at least mention in our audit report that such kind of a claim which has come up post balance sheet date, but before our signing of the auditor's report, and we are supposed to mention that in our auditor's report. Now here the most important thing is what is Benami property under the Benami Transaction Prohibition Act, and that the definition is very clearly mentioned how exactly you identify. A little complicated one, but one need to see that Benami Property Act and decipher about whether this complaint or any proceeding which is initiated under the Benami. Not all the proceedings which comes under the property are supposed to report. It is only under the Benami Transactions Prohibition Act that we are supposed to report here. Move on to clause number 3.2. This clause is for the inventory. Inventory clause was there earlier also. Now there are certain modification which they have put in here. So whether the physical verification of inventory which is carried out, which was there earlier, what is required is in an auditor's opinion, the coverage of procedure and such verification by the management is appropriate. So now we need to opine on the appropriateness of the verification. So if the management has the periodicity of a half yearly or a yearly kind of a physical verification of the inventory, then we need to see based on the materiality of the inventory whether it is sufficient. If not, then we are supposed to report. Second is we have to go by the actual physical procedure performed by the auditor, whether it is in convergence with the management procedures. So that we are supposed to verify and report here. Any discrepancy which is found here also, the 10% criteria which is mentioned and which is in value, any discrepancy of 10% or more in aggregate for each of the class of the inventory are noticed, then we are supposed to report. Now, at what juncture we are supposed to report is, so we need a report from the management when they have performed the physical verification of the inventory and what was there in the books and what is the difference. And that deviation, if it is more than 10% for that particular class, then we are supposed to report in our auditor's report. So that is clause number A. Now, clause number B is newly added. Now, clause number B talks about that any company who has been sanctioned any working capital limits on account of the current assets, which is in total of 5 crores in a year, and that company is supposed to submit certain documents with the financial institution and bank. Typically, what are the documents? This document covers the stock statement, the debtors report. These are the two major reports which they are submitting. What is casted on the auditors is we are supposed to verify those reports matching with the financial statement. Why these clauses come up? Probably the need is where every quarter when the submission of the documents are happened, probably they are not matching completely with the financial statement. It is a misinformation given to the bank, and when banks have given these loans on account of those statements, then it will be probably overstated or understated. So I see this is the requirement to all these segments where the loan has been casted on current assets and whether these current assets are rightfully accounted and correctly informed to the banks and financial institutions. This basically is to mitigate the systemic risks at the banking segment, where if any loan which is given on the stock or the book debts which are not as per the books, then the chances of the NPA can be minimized. So I would just put it as a key consideration: discrepancy, as I mentioned earlier, of the total value, the 10%, the sanction limit and not the utilization. So here the key important thing is the sanction limit and not the utilization. So even if you have taken a sanction of 5 crore altogether from 3 different banks, then we are supposed to mention if the statements are not given. If we have not taken any disbursement, then the chances or case of submitting the stock report doesn't come. But even if the small disbursement has taken, then we are submitting the quarterly statement with them. Then what is next is balance outstanding for any day during the year and not at the year end. So we are not supposed to see only at 31st March 2022, but we are supposed to perform this analysis throughout the year. Any part of the year, if there is a sanction limit which is crossed 5 crores, then we are supposed to report here. Then the clause is applicable, and we can't say not applicable. Never limits to only one bank. It is aggregate of all the banks and financial institution. And the credit facility is for both fund-based and non-fund-based. So these are the pointers which I wanted to share with you, that one should keep in mind that it is applicable to all these parameters which I have mentioned and not restricted to year-end only. Clause number 3A, it is a new clause. This clause talks about loans, lending. It is a very, it's a most significant clause which is added in the current CARO. There are clause A, B, C, D, E, F, which is mentioned. So I'll take one by one each and every. Clause number 3A is not applicable to the companies who are into the principal business of giving loans. So NBFCs are excluded out of it. It is not applicable to the NBFCs. So coming back to the clause, whether during the year company has provided any loans in nature of loans or stood guarantee or provided security to any of the other entity. If so, then indicate the aggregate amount during the year, the balance outstanding, and to the aggregate amount during their balance sheet at the balance sheet date. So the requirement is of any entity other than NBFC, if they have given a loan to anybody or they have provided any advance in the nature of loans. Most important is loan is very easy to identify because there is a contractual arrangement. You have some covenants which is mentioning about the periodicity, the rate of interest and the conditions, but the advances in nature of loans is little difficult for us to identify from the financial statement. So one need to be very, very cognizance about seeing the balances in the books, about the debit balances in parties account, and what is the nature of this loan advances given, and whether it takes the color of the loan or no, that needs to be identified and report here. Then there is a guarantee which is provided or provided any security to any other entity, meaning you give your security as a protection or guarantee on behalf of the subsidiary. All has been covered here. So if you see the capital A and capital B here in the clause, which talks about any of such nature of loans or advances for the subsidiary, joint venture and associates, and for other than subsidiary, joint venture and associates, clearly distinct demarcation between the reporting of two nature, which shows the intention of the I would say the regulator, that they want to highlight all the nature of such loans and transactions which are happening with your group companies and other than group companies needs to be highlighted. So if you see that everything is becoming now apparent on the audit report, as an auditor they are supposed to mention all this with the amount, of course not with the name but with the amount, that what is the exposure at the balance sheet level which is given to the subsidiaries, joint venture and associates. Now there is definitely a reporting, one may think that in the books also, in the financial statement also, we were mentioning about two related party and not, but coming in the report itself is coming specifically on the report page. Key consideration here is loans includes long-term and short-term loan. So all loans are covered, whether being in cash or kind, that is also covered. Advance is in the nature of the loan, as I mentioned earlier, is very a typical way to go deep dive into each case of the debit balance and understand this. Then we are supposed to report in respect of all parties bifurcated into A and B, which is mentioned. So maintenance of the loan register, which is a erstwhile kind of a requirement, I would say that where the loan register should be there. So whenever any loan has been given, you should put in the loan register, which I don't see per se, which is maintained by each and every organization. But now as an auditor, we may ask them that you start maintaining a loan register bifurcated into two parts, which is to a related party and the other than related party. And that will become handy for us to, match our financial statement with the loan register. Clause number Roman 3b, the investment made and guarantee provided in securities are not prejudicial to the company's interest. It's a old terminology. Anything you lend money to anybody, it should not be prejudicial to the organization. Now, what comes to our mind is what is prejudicial to the organization is if you give any loan to anybody at a lower interest or zero interest, which we have seen or which we would have seen in many of the holding subsidiary kind of a scenario, where holding company is supporting to the subsidiary company and the loan is given at a very minimal rate or zero rate, so and so forth. We all know that India doesn't permit such kind of an activity, such kind of transactions, and they wanted it needs to be arm's length, and that it needs to be fair value. So this need has come in the evaluate terms and condition for all the loans, including long term and short term. If it is a short term, then it minimizes the risk of reporting, but if it is a long term, then it definitely attracts the risk of reporting, because we as an auditor are supposed to comment upon whether it is prejudicial or no, and we need to go into each and every nuances of the transactions, whether it is indeed a prejudicial. So as I mentioned, the periodicity, the purpose for which it is given, if it is not used, the rate of interest which is used for such kind of a loan, that also triggers the whether the transaction is prejudicial or no. Again, reporting requirement under this clause is applicable to all companies. So if I put it clause number 3, Roman 3, subclause A and subclause E is not applicable to NBFC companies. Other than all the clauses are applicable to other than NBFC companies. So we have to be very mindful when we apply this test for company to company. Clause A and clause E is not applicable to NBFC, and rest all it is applicable to all. Clause 3C, again a modification, as I mentioned. We are supposed to mention here that each and every loan which is given, whether there is a schedule of repayment, of principal and interest, whether the schedule has been stipulated in the agreement, and whether the repayment or receipts are regular. So the clause is very kind of an statement kind of reporting, that we are supposed to report stating that first there is a schedule, second it is stipulated, and third is it is regular in repayment. If any of these three phenomena is not there, then we are supposed to report stating that this is not in compliance with the CARO requirement, and we are supposed to report. Now there is a lot of concerns which is raised in case of the financial institution or financial companies, NBFCs and all, because this particular clause doesn't specify how long and how much you are supposed to report in this. Is it only the yes no, or is it even the quantification of the detail? The guidance note of institute has given some clarity on it, and we are supposed to report, but there is still a school of thought stating that are we supposed to give all the names of the entities which are defaulted during the period, or it is only the quantity, I mean to say number of loans and the amount which is defaulted. So a little different school of thoughts which is going on. If I personally feel the quantity of the loans and the number, the amount which is defaulted during the year is sufficient and not the name. But we may yet to do the clarification. But I think it is very clear in terms of the table which is given that we are supposed to report in yes, no, and the quantity. Clause number 3D, the amount is overdue, state the total amount overdue for more than 90 days. Now this 90-day concept is kind of there in the NBFC companies or bank, which is NPA. Now it is introduced even for the private organization or other than NBFC organization, where it is a reasonable time for anybody to repay within 90 days. If not, that means the party is defaulter. And if the party is defaulter, that means the company's money is blocked with such entity, and that's why the reporting is required here. So if I put the key consideration for clause C and clause D, is these clauses includes loans and advances having opening balances also. The term regular, which I already mentioned, what does regular means? At every EMI date or every point of repayment date, we should get the payment. If not, then we are supposed to say that they are irregular, and then we have to comment with the table. Third is whether the reasonable steps have been taken by the organization to recover the money. So of course it is very judgmental, where we have to go into each and every case and see the steps which is taken by the organization, because nobody wants to forgo their money. So naturally the management would have done some of the other steps to recover the money. What we as an auditor want to know is whether those steps have been documented, and whether those steps have been established to us as an auditor, that how have they tried to recover that money, and even after that steps taken, the money has been recovered or no. So we are supposed to do we are supposed to report that also as a table, which is also recommended in the guidance note, and we can put this in the table that the steps taken and any remarks you want to put it for the irregularity. Point number E, sub clause E in Roman 3. Whether any loan or advances in nature of loan granted has fallen due during the year and has been renewed or extended, or fresh loan granted to settle the overdue of the existing loan given to the same parties. Now, if you read the wordings, what it requires us to verify that if you have given a loan to X party, that party couldn't pay you, you have extended the period or you have renewed the terms of the loan, which itself in a normal financial terminology call it as an NPA. Hence, as I mentioned, clause E is not applicable to NBFC because it's a phenomena which is governed and regulated by RBI, where restructuring is possible, extension is possible with certain conditions. But for other than NBFCs or other than financial company, it is very important. As I mentioned, for the organizations which lend money to somebody and if it doesn't pay, the intention is very clear that the money is been either given for not to recover back, or there is where the money is NPA now. So we as an auditor are supposed to report in this clause stating that if there is an extension of any of the agreement terms has been done, then we are supposed to report here. So this is a pseudo NPA phenomena for the company other than NBFC. In a normal terminology or the financial terminology, it is called evergreening, that you are just shadowing the old loan and giving a new loan, or you are giving the more time to the borrower and not protecting your interest or the shareholders' interest. So this clause is added for the auditors to come up with the opinion stating that whether these kind of terms have been extended or granted to the borrower, and whether the funds of the organizations or funds of the corporate is not been protected. So this clauses come for that. Clause number F, again a new clause which is added, whether the company has been granted any loans or advances in nature of loans, either repayable on demand or without specifying any terms or period of the repayment, if so specify the aggregate amount and the percentage thereof. Again, if you see, the theme of this particular clause also speaks about if you give a loan to anybody without any covenant, without any terms, condition, the repayment schedule, then the money is given without any purpose. If there is no terms mentioned or it is repayable on demand, then such loan amount needs to be reflected as a report in our CARO report, and specifically when these loans have been granted to the promoters and related parties as defined in section 276 of the Companies Act. So what do they want is the company's money should retain with the company and it should be utilized for the company, and the loan granted to the promoters or related party, it should not raise an eyebrow stating that the funds which will be ultimately utilized for some other purpose than the bona fide interest of the company. So here again, auditors are supposed to specify the gross amount and also specify that there are no terms and conditions which are stipulated. Now moving on, clause number 4 probably is the same old clause. So I'm moving on clause number 5. This clause number 5 talks about the amount which is deposit or deemed to be deposits have been taken during the current period, and there are certain necessary compliances of the RBI and the necessary compliance of the Companies Act of under section 73 and 76 needs to be adhered to by the organizations. So we as an auditor are supposed to verify all that, and we are supposed to report in the audit report whether the same has been complied with or no. So the consideration which I mentioned here is it's extend the reporting requirement related to deposit includes the amount which are deemed to be deposit. Now, deemed to be deposit is very well explained in one of the deposit rules in the Companies Act. But few pointers which I mentioned is if you have given any, taken any advances for supply of goods for provision of the services, and if it is unsettled for 365 days, then it is considered as a deemed deposit. Any security deposit for performance of any contract, if it is taken and the contract is not fulfilled, then it is considered as a deemed deposit. Application of the money for issuance of the shares or securities and it is not allotted within 60 days, then again it is considered as a deemed deposit. So these are the few instances where it can be considered as deemed deposit. We as an auditor are supposed to see the money which is coming and whether within the specified time which is mentioned here is been utilized for the purpose for which it has been taken. Otherwise, we are supposed to consider it as a deemed deposit. We are supposed to report here. Possibly the organization has not complied with the regulations of section 73 to 76 and RBI because they were not aware about these clauses. Some of the companies have not analyzed this. So, but we as an auditor are supposed to report and put it as a qualifying remark. So I've already mentioned about the compliances which is required. So there are certain forms which you need to fill in with the MCA, which is DPT3, or we have to mention to RBI as well if it is in the nature of the deposit. Clause number 3, subclause 7, whether the company is regular in depositing undisputed statutory dues, including goods and service tax and provident fund. Now, so clause number A is the old clause only, where we are supposed to mention whether the company is regular in depositing the statutory dues, and which is very, very important for the organization to know that if the statutory dues are paid or know on a timely basis. And what we need to see is, as on 31st March 2022, any dues which are more than 6 months old, is older than more than 6 months, then we are supposed to mention here, otherwise not required. Clause number B, there is a small addition or the modification which is coming, whether statutory dues referred in subclause A above have not been deposited on account of any dispute. If so, then we are supposed to mention in this clause stating that what was the dispute, what was the amount which was demanded, and where the current status of the litigation stands. So take an example, if it is under income tax, the demand is raised, it is under CIT appeal or under tribunal or wherever the appeal is pending, or it is under any other act, custom act, or it may be, because earlier, if you see in many organizations, still the dispute or litigation is still on under custom and excise act, and we are still continue reporting. So these amounts are demanded, these amounts are not deposited, and they are under dispute. We are supposed to disclose here. So this is the more of a disclosure requirement. But what we as an auditor need to do is we need to deep dive for each and every such disputes, along with the legal, along with the professional being into export of the income tax or indirect taxation. If need be, we can take the certificates from them stating that as per you, what are the disputes which are pending and we have not paid, and then accordingly frame this reporting requirement. This is clause number 3.8. It is a new clause which is added, whether any transaction not recorded in the books of account have been surrendered or disclosed as income during their income tax assessment. If so, whether the previously unrecorded income has been properly recorded in the books of accounts during the year. Now this goes into the section 158B of the Income Tax Act, which defines the undisclosed income, which states that any money or bullion, jewelry, or any other valuable articles or things, or any income based on any entry in the books of accounts or other documents and transactions where such money, bullion, jewelry, valuable article, things, entry in the books of accounts or other documents or transactions represent wholly or partly income or property which has not been or would not have been disclosed for the purpose of IT Act, or any expenses, deduction, and allowances claimed under the IT Act which is found to be false. Now, these are all talks about the undisclosed income. If during the year any of this undisclosed income has been disclosed or has been, identified by the income tax authority, and it has been, I would say, confirmed that this is undisclosed income, then we as an auditor is supposed to report here. The company is supposed to, account for the same in the books of accounts appropriately, and accordingly it needs to be reported here. So the few pointer here is income disclosed under force and coercion cannot be treated as income surrender. It's a different story because it is not an undisclosed, which is an identified, it has been forced, so it's not to be considered. Surrender or disclosure of the unrecorded income might relate to any assessment year under the IT Act, but if the same has been come and unearthed in the current year under any of the procedures of the income tax, and that needs to be reported in the current year. So it is not the year of the assessment which is important, it's the year in which the same has been converted or identified, in which we are supposed to report as an audit report. And ensure that the income surrender or disclosure should be duly recorded in the books of account, which I mentioned. Ensure proper disclosure in the financial statement of the company by evaluating the requirement of Ind AS and AS to enable users to understand. So what probably this allude to is we are supposed to put even a note in the financial statement stating that something of this sort of transaction also has been accounted in the current year, which is an exceptional item, which is not a regular item, and that also we are supposed to put it in our auditors report, and ensure that the internal financial controls are operating effectively with respect to recognition of revenue income. Now this is very, very important because anything which is come up here as unearthed income, eventually it takes the color of the income of the company. So we have to, read the Ind AS 115 or the revenue recognition criteria and how exactly we are supposed to reflect in our financial statement. The internal control, why? Because we have to also put such kind of a things in our internal controls if it is not there as a part of the IFC. Clause number 9, we have extensively discussed about the lending part in clause number 3. Clause number 9 talks about the borrowing. So it is exactly the vice versa. So what we needed here is, if we have borrowed money from anybody, then whether we have defaulted in repayment. So the clause reads whether the company has defaulted in repayment of loans or other borrowings, or in the payment of interest thereon to any lender. If yes, the period of the amount of default to be reported as per the format below. Very looks simple requirement, that any of the default you have made in payment, now that will be coming in the auditor's report. So earlier there was never a requirement to disclose such kind of information, but now this will become open information, where from which lender you have taken money, what is the nature of the borrowing, in that nature of the borrowing, what is the amount which is not paid on due date, whether it was a principal or an interest, and number of delays which is unpaid. So it's like an open book, where if you are a defaulter, then every default will be surfaced on the auditor's report. Auditor is supposed to validate each and everything, because we are giving an opinion. So the accuracy of the information going in this particular clause is very important, because of course there will be a lot of resistance coming from the management to disclose such information. But we as an auditor have no choice. It is mandated by the regulator, and we are supposed to mention it. Quite detrimental from that stand, because all the organizations are levered companies. They have some of the other leverages which is taken from the banks or financial institution. So any of such information comes up on the audit report openly will definitely hamper them tomorrow for the credit, credit rating. But this is how it is. This is probably a tool where maybe there is a person who is a willful defaulter and a genuine defaulter that may come up by this. A genuine defaulter will definitely make up again in some time, but the willful defaulter will not. So that's the kind of a the disclosure which will come up here. The key consideration according to me is, default in relation to this clause means non-payment of dues to lender on the last date of specified loan. So what is last date is mentioned as per the covenant of the agreement. We need to read through and decide upon whether on that last day, whether the interest was payable, whether the principal was payable and not paid. 2, the new format which is given, we are supposed to report in the new format security wise. 3, the clauses cover defaults in payment of loans or other borrowings, including principal interest. The clause also covers rescheduled, restructured loan as well. So if we as a borrower and we have rescheduled the loan with the banks or financial institution, and that also is defaulted, that means that also will be covered here. So it is very and in remark also one may say that this particular loan was rescheduled or this particular loan was restructured, and even then it is not paid, and it becomes an open meaning. Imagine there will be a lot of questions now coming to the auditors from the credit rating agencies about the information which we disclose in this audit report. So we have to be very clear about what information we put. The accuracy of that information is very important. Clause number 9, subclause B, it is a new clause which is added, whether the company is declared willful defaulter by any bank or financial institution. As I just mentioned in the earlier clause. Now here what additionally the auditor is supposed to write, whether the company has been declared as a willful defaulter. Now it is never a published information per se. It's very difficult for the auditor to find out directly. What we need to approach, either one is definitely in the public domain, whatever information is available, we may look for it. We have to ask the management about any letters if they have got it from any of the lender party, which is bank and financial institution, and they have declared them as a willful defaulter. The willful defaulter per se, as if I go to the consideration part of my PPT, whether the company has been declared as willful defaulter or has been issued a so-cause notice by any lender or a bank or financial institution or government as per the procedure prescribed by RBI, then it is considered as willful defaulter. No per se a definition which is given, but this is how one can allude to whether it's a willful defaulter. Information on the willful defaulter can be obtained from credit information company. Only those people who have a privy to such kind of information will be able to get this, or on a website of the RBI if they have published something and we get to know about it. Maybe some published news, maybe in the newspaper or wherever it is in the public domain it is available, we can take that into cognizance. The guidance note limits the scope of other lender to government and government authorities, but according to me, I think when the banks and other institutional also, when they declare as a willful defaulter, we should supposed to report it. Information at the balance sheet date and on the date of the audit report would be considered. Now, how many times in a year, 365 days, we will not be able to vouch for the entire activity, but definitely if during the year we hear about it, or as on 31st March, if on that day anything has come up to our knowledge, then we have to take into consideration and report on this. 9C, modification again, whether the term loan are applied for the purpose for which the loans were obtained, and if not, the amount of loans so diverted and the purpose for which it is used may be reported. Maybe a little old clause, that's why I said modified. Obviously, the loan for which you are, the purpose for which you are taking a loan needs to be utilized for the same purpose and cannot be utilized for other than the same. As far as the banks and financial institutions are concerned, they are very, very particular about taking the end-use certificate on every periodical, maybe quarterly or half-yearly basis, and they ensure that the management gives them a certified copy or maybe audited copy from the auditors, stating that the end use has been taken care of. But imagine for the cases where other than banks and financial institution, you borrow for one purpose, utilize for other purpose. The utilization may be into capital market segment, or maybe in a real estate segment, or maybe to lend to some third party for which the end use is not known. Eventually the organization who has lent money or organization who has borrowed money, they are coming into trouble. Hence this clause is come into picture that they are writing the purpose for which the loan has been taken. If it is diverted, then we are supposed to report here. I would not say it is difficult to figure out from the bank statement directly whether the loan, when the loan was borrowed, where it is utilized, because the utilization may be on a tranches, not immediately. So we need to take the fund flow of the company. We need to take even the cash flow of the company, how exactly the money has been utilized over a period of time post borrowing, and we need to conclude whether the same has been used for the purpose for which it has been borrowed. So the consideration point which I feel is the term loans obtained from entities or a person other than banks and financial would be considered in this clause, because for banks and financial institution is taken care of. Diversion would be examined as per the instances defined in the RBI circular. Now, RBI has given certain examples of what could be the diversion called as, and that we need to take into cognizance and then accordingly report here. Now, in case of term loan has not been utilized for the purpose for which it is raised, then the auditor would report the amount of loan diverted and the purpose for which it is used. As I mentioned again, we have to be very vouchful of what we report here, because we have to have a very accurate information and only then we report. Otherwise, it will be question to us also that how have you derived to such diversion or something. So naturally, onus is on us to report, and onus is on us to report the accurate information as well. So it needs a lot of effort to figure out the purpose and end use, which is other than the purpose for which it is borrowed. Establishing a one-on-one, as I mentioned, a relationship with the amount of term loan is not necessary and not possible also, but one may take the fund flow statement and the cash flow statement, and discussion with the management also may help us in utilizing the funds for which it has been used for. Clause number D of 9, whether funds raised on short-term basis have been utilized for long-term. Of course, this is a mismatch of the asset liability for the NBFC companies or for the other than NBFC companies. It is mismatch of their own fund flow management. that if you borrow anything for a short term and use for a long term, then you will be in a debt trap. You will again borrow for repayment of the short, which is very difficult at times. So this clause is required for us to report that if there is any money which is borrowed for short term, which is less than 1 year, and it has been utilized for a long term purpose, then we are supposed to report here. So what are the consideration point is the statement regarding nature of application of fund. If the company has financed long term assets out of short term, then we are supposed to report. The comparison would be required for long term sources and long term application of fund. We need to do a mapping, and then we'll be able to understand whether the long term application of funds have been met out of long term sources only, which is not very difficult, because you have a very few projects on which the long term fund is required, and you can correlate with the borrowing schedule, that what are the periods of the borrowing. Movement of the fund should support by relevant documentation, and review would be required of balance sheet, cash flow statement, and the current ratios. So some ratios can trigger this phenomena if we have a very high current ratio that shows that we have a very short term kind of a current assets or a current liability. Clause number 9E, new subclause added. Whether the company has taken any funds from any entity or a person on account of or to meet the obligation of his subsidiary, associates, and joint ventures. If so, details thereof with nature of the such transaction and the amount of such cases. So what does it require is company has any funds from any entity or person on account to meet the obligation of subsidiary. So we borrow funds and we utilize for subsidiary or associates to meet their obligation. So it is not the loan, it is to meet their obligation. So we pay to the external vendor directly and then create a loan for the subsidiary. Then such kind of a reporting which may require. So according to me, any of the obligation of the subsidiaries are met that show that the subsidiaries need funds and we have not lent them, but we have paid it to the vendor directly. The term entity in this clause would include bank, FI, company, LLP, trust, government, everything. Auditor need to consider new loans or advances given during the year, meeting the obligation of the subsidiary during the year. Obligation would meet the amount that subsidiary or associate joint ventures are required to pay themselves to the vendor, lender, employees, and statutory authorities. So as I mentioned, that the company is not paying money to those people. It is our company or the subject company who is paying on behalf of them. Then it is required to be reported here. And clause covers both long term and short term funds which has been utilized for the purpose for the subsidiary and joint venture. Moving on, clause number 10F. This is the new subclause added in the current year. Whether the company has raised loans during the year on the pledge of the security held in its subsidiary, joint ventures, and associate company, and if so, give details thereof and also report if the company is defaulted in repayment of such loans raised. So again, kind of a systemic risk category or condition where you have pledged the security of the subsidiary, you have borrowed money, and that borrowed money also has been defaulted. So imagine the company is into trouble, the subsidiaries also will get into a trouble because their shares have been pledged, which has been considered here tomorrow. So this is the reporting requirement which is come up new in the current year. The securities held in its subsidiary, joint venture, and associate company means the investment of the company in such subsidiary, joint venture, and associate company. And then we pledge those shares for borrowing. Default includes both repayment and principal, and this clause covers all loans taken during the year, even if these have been repaid during the year. So the last clause is very important, that even if there is a default during the year but repaid at the end of the year, then also it is required to be reviewed and report here. Roman number 11, this clause is the modification and B is the new clause which is added. Whether any fraud, now here highlighted portions are a little new, which is any fraud by company or any fraud on the company has been noticed or reported during the year, and if yes, the nature and amount involved is to be indicated. For the large organization like listed companies or the large companies where they have a lot of verticals, where the governance is high, they have a policy of the fraud which is mentioned. They have the fraud register which is maintained, and any of such instances which has been detected or which has been reported are reported in the fraud register, and there is a proper investigation happens on that. So here the mention is fraud by the company or fraud on the company. Any external person has done any fraud on the company or any fraud done by the company, and any complaint which has come to the company needs to be looked into, and we as an auditor need to discuss with the management, maybe legal or maybe the committee, fraud committee, who is taking care of such kind of instances, that what is the approach they have taken, whether that particular complaint has been resolved or no. If not resolved at the end of the financial year, then will there be any implication which is financial or non-financial in nature which will come up on the company? If there is any financial implication and if it can be quantified, then naturally we are supposed to provide for the same. If it is not been possible to quantify, or management is of the view that we should not make a provision of it, then take a color of the contingent liability, and we are supposed to report accordingly here. So what is more important is, as I mentioned, is for the company which are large in nature. But the companies which are SMEs, which are small in size, a private limited company, the fraud do happen. Such fraud, meaning they may or may not have any kind of such register. They may or may not have any kind of such kind of committee. So it's only our discussion with the management and the transaction during the year we'll come to know about any of such instances happened, and then we have to take a judgment on that, whether it is required to be reported here. So this is purely a reporting requirement. Clause number B is the regulatory requirement. Then if there is any fraud which is come up and which is crossing the criteria under section 143(12) of more than 1 crore, then as an auditor we are supposed to report that under ADT 4 to the central government, and the same needs to be discussed with the management for their procedural compliances in terms of resolution, how exactly they have taken, and what is the stand at the year end. So this clause is required for us to mention that if there is any fraud which is more than 1 crore has been reported to central government or no. So answer is more or less yes and no. If it is no, then not applicable, but this is what we are supposed to report. So the consideration part here is the clauses requires assessment of all frauds on any of the company, not limited to frauds by the officer or employee only, but even by the external people. Consider the fraudulent act that causes a material misstatement in the financial statement. Consider other clauses that may have implication of the clauses, example, discrepancy reported returns. I just want to highlight, in the current e-technology world, there are a lot of fraud which is happening, even the financial fraud online, by while you making a payment and the payment has gone to the wrong person, or somebody has sent you a link, you made a payment and that link was fraudulent, or somebody has hacked your bank account, or somebody has hacked your data center and they made a payment on it. So and so forth. These are all the different scenarios of the fraud, and if there is any kind of instances which has happened, we are supposed to kind of report here. So as I said that we have to be very careful and ask all the necessary questions to the management about any of such activity, maybe big or small, which has happened, and we may report here. I would just like to highlight here that our institute has, in the guidance note, come up with a checklist approach, and one may just go through the checklist, figure out all the answers on the checklist, and you will come to know about whether there is a reportable clause or not reportable based on the information which is received from the management. So please go through the checklist. Also create your own checklist based on the company specific, because this may be a very generic which ICAI has reported issued, but maybe company to company we may have to add less any pointers in the checklist. But keep doing that, because that may be the fundamental documentation for us. I'll come up to the documentation subsequently, which is very, very important for us to tomorrow justify whether you have done the proper diligent work on the CARO and come up with the conclusion on the opinion on each and every clause. 9C, again a new subclause which is added, whether the auditor has considered the whistleblower complaints, if any, received during the year by the company. Now, this is a concept largely used in the large corporates again, where the whistleblower, of course, it is mandatory for the listed companies, subsidiary of the listed companies, but certain large corporates also, as a good governance, follow this. What is whistleblower? Whistleblower activity is nothing but somebody has raised a concern, being an employee or any external person, where the activity inside the companies are not happening per se in a bona fide way. So it attracts, or it starts the vigil mechanism in the company. It is mandatory under section 177 of the Companies Act for the listed companies, for the probably subsidiary of listed company, where the audit committee is supposed to monitor this vigil mechanism, and the complaint which has come by way of this whistleblower needs to be addressed to. And if any of this complaint warrants any financial implications, that needs to be analyzed properly, and proper accounting needs to be done. And that's why the audit committee comes into picture. So whistleblower is the method by which any of such activity can be unearthed and the management take appropriate action against it. So the key consideration for the auditor is auditor to verify the whistleblowing mechanism, whether it's applicable or not. As I mentioned, whether setting up a vigil mechanism is not mandatory, then management should share all the whistleblower complaints to their auditors. That these are the complaints which I received. If you feel, you suggest, if there is anything warrants any financial implication, then the management should be happy to do that. Every complaint received by the company would be evaluated, including anonymous complaint. As I mentioned earlier, all the complaints needs to be analyzed. Guidance note doesn't require to consider whistleblower complaints pertaining to earlier years. So what is required during the year, if you read the clauses, is during the year by the company and not of the earlier years. But any earlier year case which is open and any new thing which has come up or development which has come up in the current year, probably the auditor should read that and they come up with whether it is a reportable transaction or no. Clause number 12, again a new clause, which is for the Nidhi companies. So there was a reporting earlier for Nidhi company which was there. Now what they've added in ABC, there are, unlike any other regulated entities, the net own fund requirement is mandated here. So they say whether Nidhi company has complied with net own fund to deposit ratio of 1:20. If not, we have to report. Whether Nidhi company is maintaining 10% unencumbered term deposit. Again, if not, then we have to report. And whether there has been any default in payment of interest and deposit or repayment thereof for any of the period. If not, we have to report. So the consideration criteria here is we have to report if all the three or any of this is not in compliance or there is a default, and the report the period and amount of all the default or existing at the year end or any existing during any period and made good during the period also needs to be reported. So this clause is very clear about what is required, and we need to perform the test of the 1:20, or we need to see at the year end whether the term deposits are more than 10% or no. Clause number 14, whether the company has an internal audit system. This internal audit requirement was there in the earlier CARO, I think 2003, which is done away with and now introduced again. Two clauses here which talks about whether the internal audit system is commensurate with the size of the company, and two is whether the reports of the internal auditor for the period under audit were considered or not. So two important factors I would say here. For all the listed companies or the subsidiary of the listed company, it is mandatory. There are criteria defined under Companies Act for which the internal audit is also compulsory to be performed. For the NBFC, banking companies, or whoever, also these criteria are defined. But here what we as an auditor is to see is the cases where it is not mandatory to do the internal audits. Then we are supposed to write it whether the audit system, internal audit system, is commensurate with the size of the size and nature of the business. So this clause require a comment on internal audit system and not necessarily clause A, not necessarily internal audit. And clause B talks about the auditor's report. And in auditor's report, they are talking about for the period under audit, which is the full year. So what we need to see is whether the entire year has been covered for all the transaction which is mandatory and not the part of the year, because the period under audit is nothing but the financial year, which is April to March. Some of the factors that should be considered while designing the internal control functions, which is also another part to commensurate for the clause number A, is what is the size, what are the qualification of internal audit if you want to appoint externally or internally, the reporting responsibility of the internal auditor, the involvement of the audit committee, and so on and so forth. Clause number 16, B, C, and D are the new clauses which is added, where the company is required to be registered under RBI Act 1934, which was there earlier. What we need to perform is the test of the financial assets and financial income test. We need to report here is whether the registration has been obtained, clause number A. Clause number B, whether the company has conducted any activity which is NBFI activity or a housing activity without taking the certificate of registration, then they are required to report. So imagine this clause talks about that there are certain companies, probably they are conducting the activity of NBFC, probably they are conducting the activity of financing the housing sector, but not taking the certificate of registration, and hence it is specifically added as a question or a clause in the CARO, where auditor is supposed to report that if there is such activity happening, then we are supposed to comment. Whether the company is a CIC company, again the CIC company which is defined under RBI, and there are certain criteria which needs to be followed, only then needs to be considered as a CIC. We are supposed to mention whether the company is a CIC defined under RBI, if so, whether it continues to fulfill the criteria. So it is not at the inception where you are CIC, you are permanently CIC. You have to evaluate every cutoff date, maybe for us it's a year end, whether there continues to fulfill the criteria. If there is any breach of the criteria or if any deviation of the criteria, then they are supposed to take a necessary regulatory registration. Clause number D, it is not of the subject company which is under audit, but we are supposed to report even whether the group has more than one CIC as a part of the group. Now this is more of an informative statement where you will come to know that if there are more than one CIC company, then the regulator, which is RBI or maybe MCA, can deep dive why there are 2 or 3 verticals of CIC in the same group, and what is the modus operandi probably for that company. So I would see more of an informative statement that we are supposed to ask the management and ask, is there any other than this company any CIC? So I've just highlighted and put the clauses as per the RBI circular. What is it called as a CIC company, which has a asset size of not less than 90% of the net asset, which is into investments, and so on and so forth. So these are the criteria which we need to look for, check, and then say that they are continue to be CIC or no as in the date of the balance sheet. Clause number 17, it talks about the cash losses in a period. Now this typically want us as an auditor to state whether the company has a sufficient cash which is generated from the operating activity. If not, then they are generating any cash losses. So the probable mistake which one can see is, let's see the cash flow, and whatever is there in the cash flow, if the cash flow from operating activity is positive, then it is not a cash loss. If the cash flow is negative, then it is a cash loss. No, it is not the case. You have to even consider the financing expense and financing income which is falling in the part of the third slab, and consider that you have to. So in our guidance note, what is mentioned is the how do you compute the cash flows, and we need to probably adhere to make a tabulated form, put your adjustment of plus minus into that and come up the cash flows, and then only report in this particular clause. I have to rush through a little, probably the time is 5:20, so I need to finish few more slides and I'll rush through and take up the question answer. So on the cash loss, I think that is the most important thing. So as far as Ind AS balance sheet is concerned, all the OCI transaction, all the fair value transaction, all the provisioning under ECL and all needs to be negated, and this needs to be file arriving the cash profit or a cash loss. Clause number 18, which talks about resignation of the statutory auditors. There are, in recent past, there are many phenomena which has happened where there is a resignation of the auditors have happened. We are supposed to mention Is there any resignation of the auditors have happened? If so, whether the auditor has taken into consideration the issues, objection, and the concerns raised by the outgoing auditors. So we as an incoming auditors are supposed to take the NOC from the previous auditors and see the reason of resignation, and accordingly take the appointment of the auditor, whether you are in agreement for the reason for which they are resigning. Are you okay with or no? How do you find the reason of resignation also, which are mentioned in a resignation letter of the auditors, or which may be there in the minutes of the board meeting or any of the audit committee presentation? So the incoming auditor would consider the potential impact of the resignation by outgoing auditors on audit strategy and reporting, and accordingly it can formulate its own procedures, that the reason for which the earlier auditor is resigned, I should take an extra vigilance, I should take extra care of taking the necessary documentation, or whatever the reason it could be during my audit procedures. Clause number 19, very I would say again an onerous reporting point for us. I'll just read out quickly. On the basis of the financial ratios, aging and expected dates in realization of financial assets and payment of financial liability, other information accompanying and financial statement, the auditor's knowledge of the board of director and management plans, where the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that company is capable of meeting its liabilities existing at the date of the balance sheet date as and when they fall due within a period of 1 year from the date of balance sheet date. If you see no full stop which is given in this entire statement, and we need to comply each and every word which is mentioned here. So the clause itself talks about what are the inputs which you need to take and what could be the output of that, and we are supposed to report whether the company is capable to meet its obligation in the near future, which is 1 year down the line. We are not supposed to maintain for a long, but 1 year down the line. What it requires is whether the company has sufficient funds to meet the obligation in the subsequent year. So a lot of subjectivity, a lot of inputs which we need from the management, a lot of deliberation which we also need to make, because we are the one who are making this statement. And if tomorrow something goes wrong, probably our neck also will come into the radar of saying that you only mentioned that the company has a capability. Now you tell me why company has not paid in the 1 year's time. So what are the parameters they have given in the clause itself? If you see the financial ratios, we all know schedule 3 which has come up. In schedule 3 also the financial ratios are required to be reported. You can take a cognizance of financial ratio and say what is the status today, what was the status of the previous year, because we have 2 years financial ratios readily available, and we can conclude on that. Then second is the aging and expected dates of the realization of the financial assets. So this is nothing but some kind of asset liability management mechanism where the management has their own MISs. What are the near-term liability, what are my long-term liability, and what are my near-term assets which are realizing during the year, so that I can meet an obligation of the near-term liability. So the consideration which I have mentioned here is the clauses require reporting on company's ability to meet its liability falling within 1 year. In absence of the definition of financial asset liability, one can take the references from Ind AS 32, which clearly defines the financial assets and liability. Auditor to consider the paragraph on material uncertainty or key audit matters on going concerns. So what are we supposed to write? Anything, any qualification you put it here. That means you have to be very, very careful about in emphasis on matter also, because you are indirectly highlighting that there is a going concern, a concern on the going concern of the company. If it will not be able to meet the obligation in the 1 year's time, then how will it meet the obligation in future also? So we have to do a lot of homework for this clause and then only reply on that. Now the word, if you see, is material uncertainty. So there may be uncertainty, but there will be a material uncertainty. So if the mismatch is very small and which can be minimized, then probably we have to take a judgment. It's a subjective thing which you need to take into consideration. So as I mentioned, the test of existence of material uncertainty is to be performed on the date of audit report for the position of liability. Reporting under these clauses is not exactly the same as assessing going concern assumptions. The going concern assumptions, whenever we take a note from the company or organization, it is always for the 3 years, 5 years horizon. It is never for 1 year. So on the over a 5 years horizon, only then you decide upon the going concern. If the company is still making kind of a loss, then you may assess for the deferred tax asset creation also how exactly this going concern note will help us. But we are supposed to report only for the 1 year criteria, whether the company will be able to meet its obligation in 1 year or not. Now the other way of seeing it is whether the company has a sufficient bank line to create the borrowing, that if there is any shortfall in the financing, if there is a bank line of CCOD which is there readily available, then company can be able to manage all these liabilities for the near term future, and the ratios and all which I mentioned. So refer the one prepared for the schedule 3 which I mentioned. Moving on, clause number 20, it's a requirement of CSR which is newly introduced. What is required here is the applicability. We need to consider the applicability of the CSR, which is section 135, whether it is applicable to the company or no. The section is clearly defined. It is applicable if there is a profit in the previous year and there are criteria which is mentioned in the section 135. If yes, then we have to compute the amount, meaning the management has to compute the amount of the CSR amount needs to be spent. Now, CSR amount can be spent into two ways. One is by way of ongoing project or in on the spot CSR, when you give across the donation or any of the activity to the existing projects. So the reporting requirement here into two parts. One is the unspent amount on the ongoing project and unspent amount on the other than ongoing project. If there is any such unspent amount, then we are supposed to report. And if they have not been spent, then they are supposed to be transferred to the specific bank account and it needs to be utilized accordingly. So section 135.5 and 135.6 needs to be reported separately, and we need to only mention about the unspent amount and the compliances towards that under section 135. This clause 21 is applicable only for the companies who are performing the who are doing the consolidation of the consolidation of all the subsidiary companies. So whether if there is any qualification or adverse remark in any of the subsidiary or the joint associates or the component companies, then the parent company has to summarize those qualification or adverse remarks and report in the CARO. Per se, if we all know that CARO was not applicable to the consolidation balance sheet, but in the current year, this is a new introduction where whenever the published financial goes to the public, this adverse remark of the component auditors will reflect in the parent company's auditor's report. Because erstwhile historically all the remarks of the subsidiary companies were never going to the consolidated audit report. This is the way where any of such information also will go to the public at large, which may be analyst, which may be the reader, which may be banker, that there is a qualification in any of the subsidiary subsidiaries financial. So I am through with all the major clauses which are which have come new or modified in the current period in CARO 2020. I wanted to take you through certain pointers to remember, or you can say as a tips while performing the audit of the organization, that the answer to any of the question referred to in clause 3 is unfavorable or qualified. The auditor's report shall also state the basis of such unfavorable or qualified answer. It is not only the not applicable kind of a thing, but basis also needs to be worded out. The procedures required to be performed by the auditors as per the SA standard 143.10. So there are various standards which coming into picture, and they have to be adhered to while performing the audit report. That's why I started my audit, my presentation stating that the CARO per se now become a separate audit plus the financial audit. So it's become that vast and that time consuming. So never take it very lightly. अभी तो वो भी नहीं है कि लास्ट ईयर का उठा लिया और वही कारों पे हमने काम चालू कर दिया, वो केस नहीं है. You have to draft each and every clause very carefully because it is entirely changed from that perspective. So please be very mindful about drafting the report for all the company, and it is never that one shoe will fit to all the companies. तो एक कंपनी का ड्राफ्ट बना लिया वो सब में चलेगा. वैसा भी नहीं है. So please be very careful, because these financial statements or this new CARO will be read by many entities. And I share my experience. There are a lot of questions which comes from many credit rating agencies or many bankers also about whatever is reflected in the financial statement and auditor's report. So please very be mindful about what you draft in the CARO report. Third point is ensure sufficient advance planning. As I mentioned, again, it is required because all the clauses are new. The management is not aware about our new CARO, but we are the one who has to report it. So you have to refer the checklist, you have to prepare your requirement, send it to management much in advance, whatever you need. Like for an example, if you take first property, plant and equipment, if you want to verify whether it is in the name of the company or no, you have to tell the management that I need all the papers. It is not on the day where you sign or the finalization happens. You have to tell them much in advance so that they also accumulate all the information lying across the offices, lying across the geography. They have to assimilate for you at one place, and then only you'll be able to audit. Otherwise, it will be considered as a wrong reporting, and it will not be correct. Ensure necessary information and evidence is provided on timely basis. Obtain management representation on matters. Now, of course, this is kind of a saving grace which we take it from the management, but it will not absolve our responsibility of performing the audit. So draft the management representation also accordingly, where you don't have any information and yet to want the management to confirm that, yeah, there is no whistleblowers or there is no willful defaulter which has been, done by any of the companies. Such are the examples which I am giving, but try and cover as many possible words in the management rep so that you are also safe in covering that. So in case of reporting of the non-compliances, record rationale for the same in working papers. Again, the checklist and the working paper is imperative. Order is not a limitation to scope. So scope is wide. You can endlessly ask the question and come up with your report. Exercise your professional judgment wherever it is required, rather than only application of purely objective test. Meaning tick box nahi karna hai. We have to use our professional judgment in terms of, so take an example again, a Benami property. There would be some resistance from the management stating that this will not fall into Benami, this will fall under this. So some professional judgment. We may also have to refer to some lawyers or management's lawyer asking what exactly it is. In terms of disputes, where it stands, we need to decide whether it's a really a dispute or it is just a notice which has come to us. So and so forth. Consider materiality as per SA 320. Every organization has a different materiality, level. So go by that. If there is any qualification or adverse remark is given by any individual component, there is a presumption that item is material to the component, and hence when the reporting of parent company or consolidation happens, the auditor is required to report that. So don't reevaluate again. If it is given by the component auditor, it is assumed, and you may probably take it in your consolidated report. Moving on, important clauses, common audit procedure for the important clauses. So submit to the company the questionnaire. I already covered, make specific inquiries, insist that the replies to the companies are furnished to you well in time so that you are ready with your reporting. Refer the checklist as I mentioned, which is there in guidance note, and prepare your own checklist where it is required that the informations in the checklist are less. So if you want to add your points in that, there are a few pointers on the documentation. I would put it as must documentation which is needed. Definitely you need a fixed asset register, you need the inventory register, you need a working capital information what you needed. So you may take the printouts of the sanction letters and all from the management. Details of the investment and guarantee or securities which is given, the compliance. So these are my pointers. So I'll not read out all. I will leave some time for the question answers so that probably I may try and answer a few. Probably this is the end of it. So I am done and open for any questions if you all have. Thank you. Yes, Ankit.
Yes, I request all participants, if there are any questions, you can text them in the chat box. Currently, I can't see any questions over there.
Will
So
I
we can
be able to chat
we
box,
can
right?
wait. We
I'll
can
be
wait
able to
for
see.
yes. We
No,
can wait
that's
for
fine.
2
That's
minutes.
fine. That's fine.
Yeah.
No problem. So I'll be able to see in the chat tab, right? This is the chat box. Okay.
Yes. 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 Yes.
How many participants are there, Sanket? Just for my knowledge, I may not be privy to that.
220.
So 220.
Yes.
Good. So I think the topic is digested by the participant well. So
Yes.
there
Yes.
is
Yes.
no ambiguity or no questions. But I'm fine, meaning if anyone has any question, if they want to write and you all want to share with me any of the questions to me, I will happy to answer and review along with my presentation if they need it. So we'll wait for another 2 minutes if you want to, and then take it
Yes.
up, because I
Yes.
think your next session is 5:30, right?
Yes. 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 Yes.
Okay. Okay.
Okay, sir. Hello. Yeah. Problem, sir?
Yes. Yes. We can hear you.
Yes, sir. क्या हुआ, sir?
Hello, who's there? Is it for me or Sanket?
I'm not
तो
getting
कुछ
it.
प्रॉब्लम हुआ सर कि क्या है सर?
Sir, I guess there are no questions. So let's conclude it.
सर क्वेश्चन है सर.
Okay, I think.
Okay. Okay. Okay.
हेलो हेलो
Question है?
Yes. 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 Yes.
हाँ.
सर क्वेश्चन है सर, दे रहा हूँ सर.
Ha. 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 Sir, can you write it in chat box?
Is somebody displaying the question, or I don't know?
Oh, yes, sir. Okay.
Many. Okay. So let me see. It's 1 second, Sanket.
Yeah.
The question is, most of the small companies, FA register is not properly maintained. It's sufficient to put this fact in CARO, or qualification is also required in main audit report. It's very, very, I would say, yeah, naturally in small companies, the FA register is not there. We have to inculcate this kind of an habit now, or you educate all these small companies, because if we don't report and tomorrow if it is surfaced, then it will be auditors neck into picture. So it is sufficient, yes, to report, but we have to word it in such a way that we are giving a breather to the organization to maintain internal, because overnight they will not be able to create this register for you and give you all the information. So yes, as per the requirement, you are supposed to qualify if it is if you feel that it is not available. Whether the property is in the name of the company or not will take into consideration any title related litigations. Whether the property is in the name of the company or not will take into consideration any title related to litigation. Will take into consideration even the litigation title. Yeah, definitely. See, as I mentioned, that there might be cases where supposedly company A has bought some property and the name of the company is also changed. I'll put it this way also. If the name of the company is changed but the original title deed is not changed with the name, we are supposed to mention that. So as the case, this is the simplest example. So if it is under litigation and if it is not in the name of the company, we are supposed to report. Clause number 3B, 32B is applicable to relation to stock where loan is sanctioned in excess of 5 crore, but in revised schedule 3, the management is required to disclose this part. This is the responsibility of the auditor where CARO is not applicable, but still such reporting is there in schedule 3. Yes, definitely. If it is a schedule 3 requirement which is governed by Companies Act schedule 3, then you are supposed to report that. If CARO is not applicable, we don't need to report, but it will go in the schedule 3 presentation. So it will be more of a P&D presentation and disclosure of the schedule 3 as per the instruction given in schedule 3. How to confirm limit was exceeded or not, whether as per CA, credit statement or the bank. No, we have to ask all the sanction papers during the year, which has happened during the year. Again, I'm repeating, and we have to add up all the sanction paper and define. No CA certificate, I think, is required. If I read the question well. What is loan register? Is tally ledger or the form of a form of loan register? Now, when I mentioned the loan register in my presentation is typically the organization also may mention about the number of loans taken during the year and close at the year. So what you refer is the tally ledger is of one particular ledger. What I mentioned, if you have taken a loan from 10 parties, there will be a register which speaks about the loan opening balance during the year closing balance. So if you can figure out some kind of a tool from tally coming out such report, it is considered as a loan register. Small company is exempted, but it is in crossing any limit for private limited, then CARO 2020 applicable or no? Yes, it is applicable. Where the property in the name of the company or not will take into consideration. It is repeat question. Most of the small company affairs is a repeat question. How to confirm limit? These are repeat questions. Yeah. Who is testing? Do we need to report if MAT credit was classified as current asset in QIS, quarterly statement in Q4, and in audit report it is classified as non-current assets? Now this is you are talking about the accuracy of the financial statement preparation. So if at the year end the stand which is taken as MAT credit is never considered as a current assets, in the quarterly statement also it should not have been. So if it is considered intentionally or unintentionally needs to be figured out, and based on that the discrepancies there or no needs to be reported here. It doesn't affect the drawing power, and it also, so there is no impact of the outstanding as in the year end. I don't know, that's a question, but what I'm understanding from that is the requirement is only for the sanction limit. It has no connection how much drawing you have done during the year. The disbursement is not the part of the discussion. So we have to, look for the sanction during the year from bank and financial institution. I think large of the questions are roving around clause number 1, 2 only, which is applicable to more of an SME segments or more of small companies. Okay, any other question?
So should I conclude the session now?
Sanket, yeah, I think.
Okay, sir. So on behalf of WIRC, I thank you, CA Viral Shah, sir, for enlightening and making us understand in detail and clause by clause the impact and the things to be considered while preparing the CARO due to recent amendments in Companies Act. Topics explained, that is the need, applicability, overview of CARO, points to be remembered, common audit procedures, documentation to be done, CARO reporting and considerations will definitely help professionals in preparation reporting. Thank you, sir. Thank you so much.
Thank you very much, Sanket and everybody. for giving me this opportunity. And as I said again, if you have any further question, please write it to me on my email or send me the document and I'll help.
Yes, sir.
Thank you.
Yes, sir.
And I'll close the session. Thanks.
Thank you, sir.
Thank you. Thank you, Bhavna.
So our next speaker is Ranganayaki Rangachari ma'am. It gives me great pleasure to introduce today's speaker, Ranganayaki Rangachari madam, for the topic Annual Compliance under Companies Act 2013. Madam is a BCom, ACS, ACMA, FCA, registered valuer, and registered insolvency professional. She is also certified independent director from IICA. Currently, she is in practice as a chartered accountant, registered valuer, and insolvency professional, specializing in areas of FEMA, GST, and valuation. She is having vast and varied experience of more than 20 years of working in India and China in diverse sectors of retail, offshore survey, shipping, private equity, and print media. Before setting up practice, she has handled various senior level roles in Oswald Group, RPG Food World, Elcom Group of companies, and many others. She has dealt with various aspects of business, including project implementation, fundraising, direct and indirect tax planning and assessment, FEMA compliance, FIPBI approval, group restructuring, business sale, and HR management. Besides this corporate world, she also does mentoring for the students pursuing professional courses like CS, CA, and CMA. She conducts seminar and workshops on GST and tax compliances for corporates. She is a Rotarian, travel, and stock market enthusiast. I request ma'am to take over the session. I can't hear you, ma'am. We can't hear you.
मैडम आपका जो आपने ब्लूटूथ लगाया है शायद से वो माइक का ऑडियो नहीं पकड़ रहा है, आप उसको डिस्कनेक्ट करिए। नहीं, आपका ऑडियो नहीं आ रहा है।
Is my audio audible now?
Madam, okay, अभी okay.
Yeah. I'll just share my screen. There seems to be some issue in sharing the screen. Let me just.
Fiscal consequences and physical consequences.
Can you just confirm whether the screen is visible to you?
देखिए मैडम, वापस आपको मैंने ऑप्शन दिया, वापस yes कर।
One second. Is the screen visible, sir?
अभी तक तो नहीं आया मैम।
It's saying shared. I don't see any.
नहीं मैडम, अभी तक नहीं आया, एक बार वापस ट्राई करते हैं। 2 सेकंड। ये देखिए मैंने आपको ऑप्शन दिया।
Yeah.
Yes, please.
Mila?
नहीं मैडम।
Can I then log off and log in? Yesterday he asked me to restart and then I could present it. I think the same problem is there this today also. Should I log off and log in again? But it will take 2 minutes.
चलेगा।
Yeah, just give me 2 minutes. I'll just log off and log in a minute. Yeah. Can you please give me the rights to now share the screen? I'll just share it. Just give me a second. Am I audible?
Yes, ma'am.
Yeah, just give me a second. I'll just share the screen.
Okay, got it.
Is it visible? Yeah.
Yes, we
Ma'am,
can
you're
see it
not
now.
visible, but
What is not visible? The screen is not visible?
No, no,
screen
yourself.
is visible. Yourself, your screen.
Okay.
Your camera is off, I guess.
Okay, I'll start. Yeah.
Yeah,
Thank
perfect.
you. Sorry for the disturbance. Okay. Good evening, everyone. After a wonderful session by my predecessor, Viral Shah, he had left some points for me to ponder and take it over from there. He was talking about some registers and things like that. We will discuss about all those aspects right now in my presentation. Having said that, this is a refresher course and we are talking about all the statutory compliances which are vast, so I'll restrict it to the broad levels so that in the next 1.5 hours we get a bird's eye view of the entire compliances under the Companies Act. So before we proceed into understanding this Companies Act compliances, we need to understand the background of Companies Act 2013 and the recent amendments. The entire background works in the backdrop of, to promote ease of doing business, ease of living, and to drive the mechanism of, in-house mechanism for minimizing physical interference and enhancing corporate compliance and corporate governance. So if we see 2013 Companies Act, it talks again and again on corporate compliance, and corporate governance. It doesn't mean that we were not talking about, corporate governance in the beginning. It has always been there. The only difference is 2013 Act very clearly stresses, time and again on corporate governance. Just a second. Yeah. So the entire compliance works in the background of enhancing corporate compliances and corporate governance. So basically the additional fee, late filing fee, penalty, everything is collected automatically when you file the form. So government is trying to give you the ease of doing business. At the same time, they are ensuring that the compliance habit is being inculcated in the Indian society, which has been far more or less compared to the developed countries. So if you see any of the act for that matter, whether it be GST or Companies Act or FEMA, everywhere you find a continuing penalty or late filing fee, which is actually trying to bring in a culture of compliance in the Indian society. So before we discuss about these statutory compliances, let's first understand why we need to comply in time and what are the consequences of not filing in time. So I'll take you straight away to section 403 of Companies Act, which says, any document which needs to be submitted, registered or recorded, everything will be filed with a payment of a certain fee, which is the normal fee. If we don't file them in time, then the proviso to 403 says, there are 3 proviso to this particular section. One talks about 92 and 137. What is 92 and 137? 92 is nothing but your annual return and 137 is nothing but your filing of annual statement. If we delay filing these statements even by a day, there is everyday penalty of 100 rupees per day. So this is the most dreadful section. If you don't file your MGT 7 or AOC 4 in time, there's going to be a consequence of 100 rupees per day, and it's a continuing way, just like your GST. Then this, so 192 talks about. Is on my screen paused? Seems to be some problem. Is the screen sharing paused? So 192 talks about MGT 7 and 7A, and 137 talks about financial statement, that is AOC 4, whether it is AOC 4 as alone or with XBRL or with CFS. So these two form filing is going to be a very costly affair of 200 rupees per day. The second proviso to 403 talks about any other filing which is being delayed. If it is delayed, there is an additional fee payable along with a normal filing fee. The additional filing fee is given in the chart. This chart talks about, if you file up to a 15 days delay, then there is a one-time late filing fee. If it is between 15 to 30 days, it is 2 times. 30 to 60 days, it is 4 times. 60 to 96 times, and so on. Beyond 180 days, 12 times of the normal fee, which is going to be again a costly affair. Apart from that, the third proviso, which was not in action till 1st of July, it says if there is a delay on 2 or more occasions, so if I file any form more than 2 times delay, then there is a higher additional fee, which is as per the second, the table 4 of this particular fees payable structure, which says 3 times for in case of 15 to 30 days, and beyond 180 days, it is 18 times. You can see the number 2 becomes 3, 4 becomes 6, 6 becomes 9, 10 becomes 15, 12 becomes 18. So if you are a repeated late filer of form, then higher additional fee is going to be applicable to the person. So this is where, in the backdrop, we need to understand the statutory compliances and what compliances need to be done. This higher additional fees, which is introduced from 1st July, it is applicable for all filing except 403. This 403 is applicable for all filing except annual filing, charge filing, and increase in nominal capital. They are excluded from this higher additional fee. And it is talking about 2 or more times delay. But whereas in form of filing INC 22 and EPAS 3, that is your return of allotment, if the delay is more than 2 times in the last 365 days, then higher additional fee is payable. If higher additional fee is payable, then your normal additional fee will not be payable, because if you pay column 3, then you don't pay column 4, or if you pay column 4, you don't pay column 3, right? So this is the consequences of not filing or doing the statutory compliances in time. Every section has got its own. Apart from that, the last consequences, the second section, subsection 2 of 403, which says there is a penalty leviable on the company and the officer in default. Now the question is, with 2019 amendment, most of the sections have been decriminalized. Where there was imprisonment, those have been taken away. And because it being a civil law, Companies Act being a civil law, they have tried to decriminalize wherever possible, unless and until there is a real good intention or reason to hold it criminalization as an offense there. Now, let me take you straight away to section 446B, wherein it says government always wants to promote one-person company, small company, startups, producer companies. So whenever any of these companies are going to pay a penalty, their penalty shall not be more than 1/2 the penalty which will be levied on a normal company, subject to a maximum of 2 lakh rupees in case of a company and 1 lakh rupee in case of officer in default. So if a normal penalty leviable for a particular offense is 2 lakhs, if the same thing is being done by a small startup company or an OPC or a small company, then their penalty will be 1 lakh instead of 2 lakh rupees. So this is the benefit they are trying to give it for small companies, so that they are able to do ease of doing business. At the same time, they will try to comply, but not pinch them very harshly for non-compliance. So producer company is defined under 378A subclause 1, and they are also eligible for this reduced penalty. Startup is one which has been registered under DPIT, so they are also eligible for this reduced penalty. So having understood what compliances need to be done, what are the consequences of not doing that, let's get into compliances at the what are the levels of compliance. There is something called procedural level compliances. You are supposed to hold a meeting in time. You are supposed to have certain registers in your place. If you don't have, and if it is found, there is a penalty liable on the person. And the second one is certain forms to be filed, whether on a STP mode or whether on a approval mode. So the compliance is split into procedural level and form filing level. Even at form filing level, again at procedural and form filing level, there are one-time compliances, there are event-based compliances, and there are regular compliances. So we are going to break them into parts. What are one-time compliances, what are regular compliances, and what are event-based compliances. So let's first talk about the procedural compliances, and then we proceed into form-based filing. So first one is, on incorporation of the company, we need to have the first board meeting within 30 days of incorporation. On the first board meeting, what are the certain agendas to be taken care? Opening of, approval for opening of a bank account, appointment of the first auditor for the board meeting, issue of share certificates, authorizing people to issue the share certificate within 2 months of incorporation, taking on record the MOA, AOA certificate of incorporation, authorizing a person to file 20A. What is Form 20A? With the Amendment Act in 2019, this commencement of business has come into play. So once the company is incorporated, the company is supposed to open the bank account. The shareholders are supposed to put in their share capital amount, the subscription amount, and then a form has to be filed with the registrar, which is being certified by a professional saying that the capital has been introduced, and that form allows the company to do further activity. Without filing this Form 20A, the company will not be in a position to file any other form. So this is the first form, which is an event-based form, which needs to be filed. One-time compliance need to be done by the company. Then, in the first board meeting under Section 184(1), every director is supposed to disclose his or her interest in Form NBP1. So if I'm a director coming on the board for the first time, in the first board meeting, when I'm going to enter the board, I will give this NBP1. Post that, every first board meeting of the year, in the first board meeting, which is going to happen in the quarter of April to June, this declaration of NBP1 has to be provided by the directors. This form basically discloses, in this form, the director discloses his concern or interest in the companies or body corporates, firms or other association of individuals in which he has got shareholding, in which he is interested, he or she is interested. If the interest doesn't happen in the first few meetings, it happens later, then the first meeting post to that, I'm supposed to, just a second. Yeah, is the screen visible? So post that, the interest, I get it in that particular concern or is the screen visible right now?
It's not visible right now.
नहीं मैडम, नहीं दिख रहा स्क्रीन आपका.
Can you please give me the authority to share my screen?
दिया ऑप्शन दिया मैडम. अभी बीच में आपका स्क्रीन दिखा था मैम, वापस बंद हो गया.
1 second. सर आपका रिक्वेस्ट नहीं आया, दे देंगे वापस प्लीज.
दिया मैडम.
या Is it visible?
नहीं मैडम. नहीं मैडम.
Should I log off and log in again? I'm not
चलेगा
sure
मैम.
what is. Sorry for the Can you give me the request now to share my screen?
Madam, I am.
Thank you. Okay. No, it again says the screen sharing is now paused. I don't know what is wrong.
Next slide करिए, next slide करिए मैम.
9821.
It says again it is paused.
स्लाइड ही ना ब्लैंक दिखा है, ब्लैंक दिखा रहा है पूरा. वापस शेयर करिए.
No, it says it's stopped. That's what it's saying.
टेस्टिंग के टाइम में आपने उस दिन कुछ किया था, तभी पीपीटी आपका दिख रहा था मैम ना.
वापस मेल मार्क
मैंने लॉग ऑफ करके लॉग इन किया था वापस. Okay, let me. I'm sorry. Give me a minute. I'll just again log. It says people. People can now see. It says. Is it visible? Is it visible now?
नहीं मैडम.
Can I quickly mail that presentation to the ID where I've got the mail, so that you can, or give me a minute, I'll log off and again log in it. Yeah, if you can give me the option to.
हाँ मैम, अभी पीपीटी आ गया मैम. इसको स्लाइड सुबह मत करिए और ऐसे ही चलाइए मैम.
Okay, okay, okay. So I was in your disclosure under NBP1. So if you know my interest occurs post to a few meetings, the first meeting after I get an interest in that particular organization or entity, the disclosure has to be made by me to the board. Now, wherever we have interest, in that particular case where the company is going to enter into a contract or anything, the director is not supposed to participate in that decision making. Okay, so the director is not supposed to participate in that decision making. He will not become a quorum for it. But this will not apply to a private limited company. Post to the disclosure of that interest, he or she can participate in the decision making. Having said that, if disclosure is not made, then if at any point in time the company can void the contract, which is voidable at the option of the company for provision of declaration by the director. So this is a document which generally we need to see. This document will also help us in doing an audit efficiently, because we know what are the concerns in which the director is interested, whether those are going to be a related party transaction can be identified. So this form NBP1 has to be taken on record, and it will help us in doing our audit very efficiently, especially on related party disclosure under Schedule 3 and CARO requirement. These documents will help us to gather the audit evidence. The next one is section 173, wherein meeting of the board of director has to be taken place. Every board has to meet at least 4 times in a year, with a gap of 120 days between 2 board meetings. So this is as far as not a small company or an OPC is concerned. In case of OPC and a small company, they can have 2 board meetings in a year with a gap of not less than 90 days in each of the meeting. So in case of a normal company, we need to have at least 4 quarterly meetings, and in case of small companies and OPC, the requirement is reduced to 2 board meetings, and that is not at all there in case of OPC, where the director himself is a one person who is a shareholder. In that case, only minutes need to be data needs to be minuted in the documents and kept on record. The next compliance which we need to do, or the declaration we need to take from the director, is under section 164(2). 164(2) says a director, 164 itself talks about disqualification of directors in a person of insane mind, who is discharged insolvent, and who's gone for an imprisonment for moral turpitude. It describes about so many criterions. Those people are not qualified to be a director. Section, the subsection 2 clearly talks about no person who has been a director of a company which has not filed the financial statements or annual returns for a continuous period of 3 financial years, or a company which has failed to pay the deposits along with interest, or failed to redeem the debentures, and that thing continues for more than 1 year. So such person cannot be on the boards of a company. So this declaration, this DAR 12 specifically will, in that the director is supposed to mention whether he or she is not disqualified under this particular section, and so he or she can be eligible to sit on the board of the company. Apart from that, the subclause 3 says, the private limited company can have a lot of other disqualification, but for the purpose of DAR 12, we are restricting ourselves to the financial statements. So in DAR 12, basically the director says what are the companies on the boards in which he is sitting as a director, and whether he or she has attained any disqualification because of this particular thing. Is the screen sharing again paused? Yeah.
Yes, ma'am, it is paused now actually.
I don't know, when I move from one screen to other, it is okay. Can you give me one more time request for sharing the screen? Is my antivirus stopping me from sharing? I don't know.
Yeah.
So then the next one is similar to MVP, the 8, a declaration has to be taken from an independent director. This is the requirement as per section 149(6), and even as per SEBI requirement.
Hello.
A declaration has to be, yeah.
Madam, नहीं दिख रहा है PPT.
How do I do?
मैम PPT आप मुझे मेल कर सकते हो मैडम?
I'll do it right away. I'll do it right away. Yeah.
आप मुझे मेल कर दीजिए PPT, तो मैं जो पार्टिसिपेंट है उनको मैं मैम लिंक भेज देता हूँ.
Yes.
वो डाउनलोड कर लेंगे मैम.
Yeah.
ओके. WRC इवेंट से मेल कर दीजिए ना मैम.
Okay, 1 minute.
ओके.
या मैंने आपको मेल कर दिया.
थैंक यू मैम. आप स्टार्ट करिए मैम. मैं मेल जितना भी जो है मेल सबको मैं लिंक भेज देता हूँ.
आई एम सॉरी फॉर द Okay, somebody else can also present it. You can also present it, no? I mailed it to you. You can be a presenter also. Can you do that?
मैम
आप भी प्रेजेंट कर सकते हो ना, आप प्रेजेंट कर देना फ्रॉम योर स्क्रीन।
नहीं मैडम, मैं भी वो पीपीटी ना पब्लिक इनको है ना सबको भेज दे रहा हूँ लिंक बना के, तो देख लेंगे मैम।
ओके फाइन, सो आई प्रोसीड।
आप अपने हाथ से कंटिन्यू चालू करिए मैम।
Okay, yeah. So the same declaration is required under 149(6) by independent directors also. So same thing in the first board meeting where they are going to sit, or in the first board meeting of every year, they are supposed to give the declaration saying that they meet the criteria of independence as provided under subsection 6 of 149. What are the criteria? That the independent director should not be a part of the promoter group, he should not be a relative of the promoter, he or she should not have any pecuniary interest from the company beyond 10% of their income. Their relatives should not have given any loan, or they have given any guarantee, or they don't have any pecuniary transactions beyond 2%. And they were not the director, auditors, company secretaries, or consultants, or lawyers for them in the past 3 years. Or they do not hold more than 2% of the voting rights in the company. So this declaration under 149(6) is applicable only for listed company and public company meeting the criteria of having an independent director. This next slide is a very, very important slide, which if you see in many of the small companies and mid-sized organization, they fail to maintain these registers. These registers are going to be the important document which is going to help us in our audit. Information can be gathered from there, and these are the documents which are going to help the company as a statutory auditor to get the audit done. What are the documents? The minutes book of the company, AGM minutes, EGM minutes. How many of us have ensured that the AGM minutes and EGM minutes are being gone through by us before we finalize an audit? They might have prepared the minutes. They would have made the certified true copies and circulated to people. But is the minutes book available in the registered office? Because this should be available for inspection to the members. So if the registered updated, available on record, we need to check. That will help us. And minutes of the board meeting, which will give you as to authority, whether the transaction has been taken within the authority, whether the approvals are in place. So minutes of the board meeting, minutes of the committee meeting, all these minutes book have to be there on record, and we need to verify to give any opinion in our audit report.
हेलो
Apart from the, yeah.
मैडम मैंने आपका जो पीपीटी दिया उसको पीडीएफ में कन्वर्ट करके मैंने लिंक बना के डाल दिया है हैंगआउट में। आप सब डाउनलोड कर लीजिए उसे।
That's great.
मैडम कंटिन्यू चालू करिए।
मैं कंटिन्यू करूँ ना? Yeah. I'm in slide number 15 right now. Okay. So then, apart from the minutes book, we have to look at the registers maintained by the company. What are the register of members as mentioned in the section 88(1) and rule 3 of companies management and administration rules? Register of debenture holders, register of index of members and debenture holders if you have more than 100 members, register and index of beneficial owner of shares. This we will discuss in one of our slides in detail at a later stage. What is a beneficial owner and why that particular declaration required. And foreign register of members, debenture holders and other security holders or beneficial holders residing outside India. So if you have a company which is listed outside, or they have their shareholders there, then the foreign register to be maintained. Register of renewed and duplicate share certificate as per section 46(3) and rule 6. This is to be maintained in form number SH2. So whether that is being maintained. Similarly, register of equity share, sweat equity shares as mentioned in the section 54, rule 8. This has to be maintained in form SH3, whether that is being maintained. Similarly, when the company has given ESOP, the details of ESOP, the ESOP is given as per the approval of the company. Whatever options are given, those information have to be maintained in format SH6. So whether those informations are maintained. Register of securities bought back. When the company has done buyback, the kind of shares which has been bought back and the list of shares which has been bought back. Those informations are to be maintained as per section 68 in form SH10. Register of deposit, which we all know under section 73 and rule 13, giving the details of the depositor, the details of the deposits, interest thereon, the maturity period, and all those information have to be maintained there. Register of charge, as per section 85, the most important register, which will give the list of, when we were talking in the previous session on CARO reporting, whether the company, where the sanction letters are there. Sanction letters are there, whether it has been recorded in the charges are being registered, recorded in the register. Because when we are going to talk about the title deeds of the property, if it is charged or not charged, that also needs to be mentioned. So the register of charge has to be maintained in form CST 7. Register of directors and key managerial person to be kept. Then register of loans and guarantees. This is another very important register which will help us to identify related party transactions. This is to be maintained in form MBP2. And register of investments of the company not held in its own name. You go back to CARO, the property of the company not held in its own name. Here we are talking about the investments of the company not held in their own name under section 187. This is to be maintained under MBP 3. Register of contracts and arrangements entered with the directors in which they are interested. This is maintained in form MBP 4. This particular register is going to help us in verifying the data provided in the AOC 4 as AOC 2 attachment, and to identify the contracts in which the related party transaction is there for your disclosure under Schedule 3, for your disclosure under notes to accounts. So these register, if they are maintained, then it will be easy for us to get our audit in place and audit evidence on hand available. Then this is as far as the procedural compliances are concerned. I said, registers have to be maintained, board meeting has to take place, EGM has to take place in time. EGM is for in AGM, we have 4 ordinary business to be transacted every year. What are they? Adoption of your audited accounts, appointment of statutory auditor, appointment of director, and declaration of dividend. These are the ordinary business. Anything apart from these 4 will be a special business. And in between 2 AGM, if there is a need to get the shareholder approval, the only way to get the approval is to go for an extraordinary general meeting. So the meeting have to be conducted in order. You have to give 21 days notice. The board has to call for a meeting, issue the notices, 21 days clear notice has to be there. Then the meeting has to be called for order. The quorum has to be there. If it's a special business, then the explanatory statement has to go. And once the meeting is called for an order, the meeting is in order, the matter gets transacted and the resolution is passed. We will talk about MGT 14 in one of the slides. So once the resolution is passed, then it is put to action. So the details of that meeting has to be minuted in the minutes record, and the minutes have to be signed by the chairman, and those records have to be there. Minutes books are the permanent records of the company. So it is not 8 years, 16 years. These are the permanent records of the company, and they have to be maintained. And AGM minutes are available to the shareholders for inspection, and board minutes are available to the directors for their inspection. So these information have to be on there on record. How many of us are called for this information? How many of our small type, probably small companies do know aware of these requirements and they are maintained on record? So we need to get all these things up and running and available with us. So with the new CARO, with the new requirement under the Companies Act, it is substance over the form. The records, the registers have to be there. Just filing of forms is not going to help us, because when we look at startups or company going for funding, these documents are going to go for inspection. You know, their legal team is going to sit on it and do a due diligence on it. So how much our clients are prepared for that exercise, you know, we need to understand, and how much of these information are going to help us in our own audits, we need to understand. So now we will start with the form filing compliances, the documents which are to be filed. The documents what we file with MCA are taken on record on two types. One is an STP form. You file the document, it is taken straight through process. There is no approval, no scrutiny. So STP forms you file, you get, you know, your form filing is completed. There are some forms like, you know, change of name of the company, you know, charge, you know, all these things are approval forms. So you submit the form. If there is anything required for clarification, it will come up for resubmission, and then you get the documentation completed. So the forms have to be filed. The first form we will discuss about is a director KYC. This is the simplest compliance a company has to do. If we fail to do that, there is a penalty of 5,000 rupees. What does this form talk about? Every director has to file one physical KYC once. It was done 2 years before. And this physical KYC can be done again when there is any change in the data what we have provided, like an email ID or a phone number or your address or your name change or something. If that has to be done, a physical form has to be submitted. This form is certified by a professional. And once that form is done and there is no changes year on year, before 30th September, we have to do a web KYC. So basically you log into the portal, verify with the OTP given, which comes into your mobile and email ID, complete the KYC. Why this didn't, you know, DIR3 KYC has come in, we have to understand the background. 2016-17 ROC had struck off many companies, you know, saying that, you know, they have not filed their records, you know, that they were non-existent. One of the claim they said is many of the directors on the boards were not their real face. They were the drivers and peons of the organization, and they wanted all of them to come on record. So they started this KYC process. So we've done it physical KYC. Unless until there is any change in the data, it is done as a web KYC. This is to be done by 30th of September, failing which it won't allow you to file any form with that particular DIN number of a director. It will first ask you to do the KYC and then form any of the forms. Simple compliance, but sometimes we get missed out. The next compliance is MSME 1. See, this MSME Act has directed the companies or the entities to pay MSMEs within 15 days and maximum period of 45 days. So if we have a vendor who is registered as an MSME, who's got a Udyam registration, who comes up and tells you that I am an MSME, their payments have to be released before 45 days. If we fail to release that payment within 45 days, the details of those payments which are outstanding have to be reported to the registrar through this MSME 1 form. This is a biannual form. So, you know, half yearly we file this form. The due date for October to March is April 30th, and due date for April to September is 31st October. We need to understand with the new Schedule 3 requirement, the details of payment due to MSME has to be, even before this amendment, payment to MSME was to be reported. So if there is an MSME form filed by a company and that particular data is not matching with what is filed in Schedule 3, then there is going to be a problem. So we need to reconcile these two information and ensure that the data is in order. So what is in the form and what is in the Schedule 3 presentation needs to be matched. Another problem is when we file MSME form, we are confirming that we have delayed the payment for whatsoever reason. That means if you fail to pay MSME within 45 days time, we are supposed to pay with 3 times the interest, RBI rate of interest, to the MSME along with the payment. So that means we are acknowledging that we have delayed and it may have to be paid. It has to be paid with the additional interest payment. So this is the significance of this MSME form. If there is no liability to be paid to MSME, or which has not been delayed, then there is no need to file this nil form for MSME. So that is the MSME 1 form. The next important compliance, which we have been scratching our head for the last 2 years, and at least in the first year we did, was to file form DPT3. DPT3 is basically a return of deposit, wherein in the third section we file details of data, those amounts which are not considered as deposits but still needs to be reported to MCA. So this form EDPT3 is a return of deposit. The part 1 was a one-time form which was filed last but 1 year, and part 2 is for the deposit which are considered as deposits, and part 3 is for transactions which are not considered as deposit. Transactions which are not considered as deposit we'll see in the next slide. So by chance, if in DPT3 part 2 we file something for a private limited company, look at the impact of it. Private limited company is not supposed to accept deposits, but by mistake or for whatsoever reason we have filed part 2. There is a problem. So this form has to be filed meticulously after going through the provisions very carefully. So this form has to be filed by a company, except a government company. Apart from government company, there are certain other companies which are exempted from filing this form under Rule 1.3 of Companies Acceptance of Deposit Rules 2014. Who are those companies? Banking company, NBFCs, housing finance company registered with the National Housing Bank. Why? These companies are already filing their returns with the Reserve Bank of India, so hence they are not being asked to file DPT3. Now in the DPT3 third section, where we are going to file transactions by a company not considered as deposit as per Rule 2.1c of Companies Acceptance of Deposit Rules. What are those transactions which are not considered as deposits? Amount received from government or a foreign government or foreign bank, or amount of guarantee from the government. So you can see in some startups they will get soft loan from DPT, from DST, or they could get it from BIRAC, or they could get from any of the government agencies. These are exempt deposits. So when they get, sometimes this question comes: are they eligible? Private limited companies, are they eligible to get that loan? Yes, they can get, because there is an exemption very clearly carved out. So this is not considered as a deposit. Money received as a loan or facility from any public financial institution or any insurance companies. So that is also not considered as deposit. Intercorporate deposits are not considered as loans. Loans from a director of the company. In a private limited company, the company can take loans from the director. So the loan taken from the director is also considered in the non-deposit. Subscription money received towards securities, unsecured loans, the amount received by the company from an employee, and this is a very important last point, amount received as advance by the company for supply of goods or provision of services which is not overdue, which is overdue for more than 365 days. If it is less than 365 days, it is not considered as deposits. But if it is more than 365 days, then it falls in the criterion of deposits, and there we need to do some kind of firefighting, and we should ensure that it is not there. So the due date for filing this DPT3 is 30th of June, unless until is extended by the government. Otherwise, as per the provision is this 30th of June. Now the question is, the data filed in DPT3, should it match with your audited financials or not? Ideally, it should match. Maybe the problem is, audit might happen in the month of August or July, and DPT3 was filed before, hurriedly without finalizing the data. There is a bit of problem. So before filing DPT3, the information has to be, the cleanliness of the data has to be verified, the hygiene of the data has to be ensured, and then form DPT3 has to be filed. So this DPT3 again will help you to identify violation of deposit criterion by private limited company for CARO reporting or for your normal audit reporting. The next compliance is in case of an unlisted public company is filing of PAS 6. What is PAS 6? It's nothing but the share capital reconciliation audit report. So every unlisted public company has to report the details and changes in the share capital. This is filed on a half-yearly basis and based on each ISIN. What is ISIN? It is the International Security Identification Number given by NSDL, and this has to be filed within 60 days from the end of each half-yearly year. So what are the due dates? For the October to March period, it is 30th of May, and for April to September, it is 29th of November. We need to understand here, it is 29th of November because it says 60 days and not 2 months. So this share capital reconciliation audit report in Form PAS 6 has to be filed by a unlisted public limited company. Then the very routine compliance, which most of us are aware, is our annual compliance of MGT 7 and AOC 4. AOC 4 is nothing but the financial statements to be filed by every company. Every company requires to file its financial statement along with the consolidated financial statements, if any. This consolidated financial statement has to be given thought of because Companies Act 2013 is slightly different from 1956 Act on this particular consolidated accounts, because if a company has a subsidiary company, then the accounts have to be consolidated. There, the leeway of small company and all is not available. So the AOC 4 CFS is also to be filed within 30 days of conclusion of the AGM or the last date for holding AGM. We have just discussed when the AGM has to be held. The company has to first, we work in the order of reverse working. Year ends on 31st March. The accounts are prepared as per the Ind AS or AS. Then the board, approves the accounts and give it to the auditors for their opinion. Auditors expresses their opinion. The accounts are adopted. Then a notice for AGM is issued. AGM is 21 days clear notice is given. AGM is called for, held, quorum is completed, the transaction is being transacted, and then the AOC 4 is to be filed within 30 days of conclusion of the AGM. So the first AGM can be held within 9 months from the closure of the year, and thereafter within 6 months from the closure of the financial year. So the last day to hold an AGM is 30th of September, unless and until there is an extension from the government. So AGM has to be held within 30th September. What will happen if you don't hold it? Then we need to go to the registrar for approval, and that has to be prior, not post 30th September. So that needs to be kept in mind. So then after the AGM is conducted or the due date for conducting the AGM is lapsed, we have to file within 30 days the AOC 4. The AOC 4 can be discussed in 3 parts. One is for companies not requiring consolidation in AOC 4 format. Companies requiring consolidation require AOC 4 plus AOC 4 CFS, and companies which are in which XBRL is applicable to be filed in XBRL mode. Who all are liable to file under XBRL mode? Companies listed with stock exchange in India and their Indian subsidiaries. They have to file in XBRL mode. Companies having a paid up capital of 5 crore rupees or more, again they are supposed to file under XBRL mode. Companies having an annual turnover of 100 crores of rupees or above. All companies which are required to prepare the financial statement in accordance with Ind AS. So all these people are supposed to mandatory file their AOC 4 in XBRL format, because XBRL format helps in data collection and transmission and analysis easily. So what all is to be attached to AOC 4? We need to understand. The copy of the financial statement duly authenticated as per section 134. What all is to be there? Board's report to be there, auditor's report there, and other documents which are mandatorily to be attached should be there. Recently, we were going through some WhatsApp forwards, which said MC has been sending notices to people who have just uploaded their tally printouts. Those are not acceptable. There is a format as per which the accounts have to be prepared. Notes to accounts is to be there. Accounting policies is to be there. All these information have to be there and have to be uploaded along with AOC 4. Statement of subsidiaries as per section 129 in form AOC 1 has to be attached along with AOC 4. Statement of the fact and reasons for not adopting the financial statements in the AGM for whatsoever reason. If the financial statements are not adopted in the AGM, the fact and reason for the same is to be recorded and uploaded along with the AOC 4. Statement of the facts and reasons for not holding AGM, because if you see AOC 4, one clause will ask you, is the AGM conducted? If it is said no, why not conducted? The reason has to be attached along with the AOC 4. And in case the approval for the extension letter has come from the registrar for holding an AGM delayed, then the approval letter also has to be attached along with the AOC 4. Then the new requirement is company CSR policy as per section subsection 4 of 135 has to be uploaded. Details of other entities which are required has to be uploaded. Details of salient features and justification for entering into contracts, arrangement and transactions with related party under subsection 1 of section 188. This is to be uploaded in the format AOC 2. This AOC 2, the statutory register under related party transaction will all help you to correlate the data provided by the management to get the link of the transaction and to get an audit opinion. Then in case of a government company, details of the comments of CAG given, that has to be uploaded. Secretarial audit, we have a slide on secretarial audit. So wherever it is applicable, that secretarial audit report should also be attached to AOC 4. Director's report. Director's report is supposed to be in a specific format for all companies and for small companies. The format has to be used. The POSH requirements, the compounding orders received during the year, then the number of meetings held during the year. All those information have to be a part of the board's report. The director's responsibility statement, their non-disqualification criteria, all those things have to be reported in the director's report. And details of remaining CSR activities, that also has to be attached. And any other optional attachment which needs to be attached is to be attached. This is as far as AOC 4, AOC 4 CFS and AOC 4 XBRL is concerned. Another important annual compliance which has to be done on a routine basis without fail is your annual return to be filed in form MGT 7 till last but 1 year. We had only MGT 7. From last year, we have MGT 7 and 7A. 7 is for all companies and 7A is for small and OPCs. This has to be filed within 60 days from the conclusion of the AGM or at the last date on which the AGM is to be held. So on March 5th, 2021, MCA amended the company's management and administration rules. The new clause rules 11 has been substituted, wherein we have a new form MGT 7A. So OPC and small company will file MGT 7A. Here a bit of caution is, when you file AOC 4, if we have a subsidiary, we have to say we have a subsidiary. When we say we have a subsidiary, it's no more a small company, then form MGT 7 has to be filed and not MGT 7A. By mistake in AOC 4, if the details of subsidiary is not taken, then automatically if you are a small company, by the threshold limit, MGT 7A will be open for us. So we have to be careful in filing AOC 4 because that particular form is going to let you decide whether 7 is applicable for you or 7A is applicable for you. Okay. Then in the new MGT 7, this ISIN details of equity shares of the companies are mentioned along with debentures and other things, because now public companies cannot transact in, trade in shares or transfer shares unless and until they are dematerialized. So this ISIN number will be there. Then in the new format, they are asking for the information of the foreign institutional investor, their name, address, and countries of incorporation, and percentage of their shareholding. That's a new addition in the MGT7 MGT 7A in 7 form. Another compliance, annual compliance, which needs to go as a part of MGT 7, as a part of MGT 7 is certification of annual return in form MGT 8. This comes as per section 92(2) of read with rule number 11(2) of companies management and administration rules, wherein every listed company having a paid up capital of 10 crores or more or a turnover of 10 or 50 crores or more is required to file the annual return certified by a company secretary, and that is to be attached as of along with the MGT 7. So that needs to be attached and filed. We cannot afford to miss this filing. Then another form which is required to be filed for every listed public company is MGT 50. That is on the report on AGM. Section 121 says that every listed company shall prepare a report on each AGM, including the confirmation to the effect that the meeting was convened, held, and conducted, and the same in E form MGT 15 is to be filed with the registrar within 30 days of AGM. So this form has to be filed without fail. The other one is this form, we are all very much aware, ADT 1. In case of a first auditor, the auditor has to be appointed within first 30 days of incorporation. Generally, we don't file ADT 1, but there are companies who do insist on filing ADT 1 even for the first auditor appointment. Then in the first AGM, an auditor is appointed for 5 years. So, to hold office till 6th AGM and so on for the next 5 years. This form has to be filed in ADT 1, and this has to be filed within 15 days of AGM. The responsibility to file this form is with the company and not with the auditor. This form has to be filed. In case the auditor resigns, ADT 3 has to be filed by the auditor, and that we need to ensure. If you don't file it, then there are every section when there is a non-compliance, there is a penalty clause, fine clause attached to that. So we can look at those sections and find out what is the applicable penal provisions there. The other form which needs to be filed is the form CRA2. This is for the appointment of cost auditors. This is specified under section 148(3). Cost audit shall be conducted by the cost accountant in practice, who shall be appointed by the board on such remuneration as determined by the members in such a manner as may be prescribed. Again, the CRA2 has to be filed within 30 days of appointment or changes in the cost auditor. Here, 15 days is not there, 30 days is there. Every company specified in item A and item B of rule 3 of company's cost audit records rules, they have to get the cost audit done. This item A talks about telecommunication industry. It talks about electricity generation. It talks about sugar and other things. So there are essential and regulated and non-regulated. So A is for regulated and B is for non-regulated. So those companies for whom the cost audit is mandated, they have to get the cost audit done, and the auditor appointment has to be filed in form CRA2. And again, which all companies is to be liable to get the cost audit done is given under table item A and item B, but the turnover should be more than 35 crores or more in the preceding financial year. So their appointment is intimated with CRA2, and the cost audit report is filed under CRA4. So the form of filing cost audit report with the central government is in the format CRA4. This has to be filed within 30 days from the date of receipt of the copy of the cost audit report. Every company specified in item A and item B of rule 3 of company's cost audit report rules have to file this CRA4. The next one is secretarial audit. Secretarial audit is, is specified under section 2041. wherein it is applicable for every listed company, every public company having a paid up capital of 50 crores or more, or every public company having a turnover of 250 crores or more, or every company having an outstanding borrowings from banks or financial institution over and above 100 crores or more. So if they fit into any of these criterion, then secretarial audit has to be there. Secretarial audit, the big advantage for chartered accountant is this: when the secretarial audit is done, it doesn't specify only Companies Act. It says every applicable law. So the secretarial auditor is supposed to do certain basic work, inputs to be gathered, and then take the decision accordingly. So if you have the secretarial audit report, draft report with you, then it gives you some kind of input or insight into your audit requirement or to your reporting requirements. Then appointment and reappointment of managing director or whole-time director or manager is to be intimated within 60 days of appointment. This is specified under section 196. The form for filing this one is MR1, and this is applicable only for listed company and public limited company. This is not applicable for private limited companies. The next form which we have been filing on a regular basis is appointment and resignation of directors, form DIR 12. So this is applicable for all sorts of companies, public limited, private limited, small company, everybody. This form is applicable. This requirement is, the provisions are given under section 149, and this form has to be filed within 30 days of appointment or resignation of the director. This is to be filed in form DIR 12. This needs to be filed within 30 days. Then the CSR requirement, statutory forms to be filed under CSR. CSR is applicable for companies having, a net worth of 500 crores or 1000 crores or more turnover, 5 crores of profit in the preceding financial year. The company is expected to spend 2% of the average profits, that is profit before tax. And how to calculate that PBT is given under section 198. So when CSR is applicable, then the company is supposed to set up a CSR committee. But there is an exemption given for a company whose liability is up to 50 lakh of rupee from not setting up a CSR committee. So if your CSR spending is less than 50 lakhs, then there is an exemption from not having a CSR committee, because once the company falls under CSR, the company is required to set up a CSR committee. The details of the committee, the report of the committee has to be a part of the board's report. That has to be there. For the companies which spend an amount in excess of the CSR obligation in a particular year, can also set off the excess spending in the future years. So the problem with CSR is, if we don't fulfill or if we violate the provisions of this particular section, then there is a liability cast on the company and the officer in default. So it is 2 lakh rupees and 1/10. So the CSR provisions have to be taken with sincerity and executed to the fullest requirement. So when CSR is applicable, form CSR 2 is to be filed. So every company which is covered under section 135(1) has to file CSR 2. They are going to file a furnish a report on the corporate social responsibility in form CSR 2. Last year, this CSR 2 was actually a part of, was a web-based form. But from this year onwards, this CSR 2 is actually an addendum to your AOC 4 or AOC 4 XBRL, or in case of NBFC, AOC 4 NBFC Ind AS. So it's going to be an addendum of AOC 4. So once you file an AOC 4, then the CSR 2 is going to be filed. Last year, it was supposed to be filed by 31st March. It was extended till 31st May because the portal was not functioning well. But now going forward, this CSR 2 form is going to be an addendum to your AOC 2 filing. MGT 14. MGT 14 has to be filed for filing certain resolutions. Here the resolutions can be broken up into three parts. One is a board resolution, the other one is a special resolution, and third one is an ordinary resolution. So in case of private limited company, the board resolutions need not be filed. Whereas for a private limited company or any other company, special resolution and ordinary resolution has to be filed, which is specified under the relevant section within 30 days from the passing of the resolution for formulating, on passing of the resolution or formulating an agreement. So this MGT 14 is commonly missed out form. If you see, if you sit for due diligence, maximum time the non-compliance will be there on MGT 14. But luckily, some forms like PAS 3, when you try to go file your PAS 3, it will ask you for the SRN number of MGT 14. So once you give the SRN of MGT 14 only, you will be able to file your PAS form. So MGT 14 is the most commonly missed out form, which we find at the time of due diligence. So there some concentration and time has to be spent to ensure that the forms are filed in order. Then another important form which could be missed out is this MGT 4, 5 and 6. What is MGT 4, 5 and 6? Section 89 talks about declaration in respect of beneficial interest in any share. Typically, this will apply in case of a 100% wholly owned subsidiary company. So if a holding company has got 100% subsidiary, to fulfill the criterion of a private limited company or a public limited company, you'll have minimum number of shareholders. So those shares are held by them as a nominee of the company. In such cases, this 4 and 5 declaration is given. 4 is given by the registered owner, means the person who is holding the share in his name. And MGT 5 is the declaration given by the beneficial owner, who is the ultimate owner of the share. Getting MGT 4 and 5, the company files MGT 6 with the registrar of companies. So MGT 4 is given by the owner in whose name the share is registered in the company. So whose name appears in the register of members. MGT 5 is given by the person who has the beneficial interest, whose name, he gives his declaration of beneficial interest in MGT 5. On receipt of 4 and 5, the company files MGT 6. This is a normal non-compliance we find at the time of due diligence. So this needs to be taken care. So once this is there, necessary entries to be made in MGT 1. MGT 1 is nothing but the register of members, post the receipt of declaration of 4 and 5 from the registered member and the actual owner. Then there is a form called BEN2, BEN2. This comes from section 90. BEN10 is filed after receipt of declaration of significant beneficial owner in BEN1. So the significant beneficial owner gives the declaration in BEN1. It is an event based within 90 days of receipt of BEN1. This BEN2 form is applicable to all types of companies. So if somebody has got a beneficial, significant beneficial interest, then they are supposed to declare their interest in BEN1 and the company files BEN2. So every company shall take necessary steps to identify an individual who is a significant beneficial owner in relation to the company. See, the difference between MGT 456 and BEN2 is, in MGT 456, it is the holder of the security or the share. In BEN2, it is taking care of the voting rights, it's taking care of exercise significant control over the company also. So the significant beneficial owner in relation to the company and require him to comply with the provisions of this section. The introduction of this section brings in more clarity, casting duty on the company to identify and report SBO to the register. So the company, so you cannot say that I have not received any BEN1. The company has to do, because this is to do with your FATCA, FATF compliance. This is to do with identifying the ultimate owners of the company. So the company has to take significant efforts to identify the beneficial owner if the declaration is not coming forward from the owners willingly. If a company fails to take necessary steps, then the company and officer in charge responsible in default will be punishable with fine, which may be whatever it is. So if a company is not sure who is the significant owner, then they can apply to the tribunal, they can apply to the registrar for getting the clarity. And, you can, aggrieved party can go to the tribunal against the order of the company or the aggrieved party. So this is as far as significant beneficial owner is concerned. The next one is statutory forms to be filed under charge forms. Charge form takes very much importance, especially in the era of insolvency. Charge forms cannot be filed beyond 60 days, with a delayed filing of 60 days. So whenever there is a charge on any asset of the company, the charge form has to be filed in time. So CHE1 is the creation of new charge or modification in the existing charge other than debenture. For debentures, the form is filed in form of CHG9. CHG2 is a certificate of registration issued by the registrar. When there is a modification in the charge, then CHG3 is filed. Then payment of satisfaction is filed in form of CHG4. Then a certificate of registration of satisfaction is given by the registrar in form of CHG5. And notice of appointment or cessation of a receiver or a manager is given in form CHG6. And CHG7 is a register of charges made by the company, which will help us in our audit very significantly. If CHG7 is not updated, the first work is to ensure that the CHG7 is updated, and then we start our audit. This form or register cannot be afforded to be unfilled. CHG8 is the application to the central government for extension of time for filing the particulars of modification where we have missed out on that time. And 9, as I said, it is for the filing of modification of charge for the debentures. So that is filed in CHG9. Next, CHG1, I said, section 77, 78, and 79, read in continuation with section 384. And as per rules, rule 3.1 of the company's rule says, how the CHG1 has to be maintained. Charge means any interest or lien created on the property or assets of the company, because this is very important when we are preparing our accounts under Schedule 3 format. So this charge, what are the assets which are on which charges are there, has to be mentioned on the face of it. Company shall file the particulars of charge with ROC within 30 days of execution of the instruments or creating or modifying the instrument. Then CHG4, I said, is filed pursuant to within 30 days of satisfaction of charge, because unless and until you remove the charge created, the property will still be showing us charge. Then it will become difficult for you to get the next loan taken on that particular property. So the charge satisfaction has to be filed in again within time frame. Then CHG9 is the charge for modification or change in the debentures. Then this is filed as per form CHG9. This has to be read in consonance with Schedule 3 reporting format with the new amendments which have taken place. Schedule 2, which talks about depreciation of the company to be provided as per the Schedule 2. Notes to account which is required to be added. The CARO provisions, the applicability of the accounting standards, whether the company is falling under AS or Ind AS. We have to follow that, we have to look into those rules. And then secretarial standards for holding meetings and conducting the meetings. So with all these information put together, the entire annual compliances has to be read. This is a vast chapter. Since I was assigned an hour and a half, I try to cover as much as possible in a bird's eye view. Any question further to this, you can contact me with my mobile number or email ID. We'll be happy to answer. Before concluding, I wanted to conclude the session with CSC in our mind. Just like the way you have your CPC in income tax, MCA has established your Central Scrutiny Center from 18th March 2021. The job of CSC is to scrutiny the e-forms filed at straight through process and forward their findings to the concerned jurisdictional ROC. So if so far we have been very complacent saying that the forms filed on STP mode is filed, the compliance is done. But now those forms are picked up for scrutiny. If they find any problem, then ROC will then prosecute the defaulters and initiate action on them. Any e-form approved through STP are later within 8 years are found to be defective by CSC. Reporting will be made to ROC, and ROC will send notices to file e-form or a document along with fees and additional fees. But the problem is this will come only for approval mode. For STP mode, no opportunity for resubmission will be given. So we have to be extremely careful. For 8 years, this form can be taken up for scrutiny. So far, as I understand, the care has not been put so much on filing MCA forms. It has to be taken with the same sincerity as we file all our audit report or any other income tax return or anything. So this is coming to effective from 23rd of March 2021. So we have to be extremely careful in submitting a form to MCA and ensure that the compliance is there. The purpose of the effect of non-compliance I've discussed in the first slide. So it comes with its own penal consequences. Every section has got its own penal consequence, and those notices are coming. And people have been, I've been told by many of my colleagues that they have received notices from MCA asking clarity on the AOC file for last year and the year before that. So with that sincerity, we need to take all the MCA forms and file them in order. This is as far as from me is concerned on the annual compliances and the statutory compliances under Companies Act. Now I'll leave it to the moderator to ask any questions if any there.
Yeah, so I would request all the participants if they would have any questions. Do we have any question list?
Yeah, madam, any question even?
Sorry?
Question
Okay, there are no queries.
And thank you very much for the.
Thank
you to the organizing.
Madam, 2 minutes. Madam.
Yes, sir.
2 minutes question. There on.
And I'm extremely sorry for the problem in the presentation. Somehow we couldn't tackle that.
No, ma'am, it was excellent coverage in such a limited time. You have covered so much. So
thank you. It's my pleasure. Because in 1.5 hours, I can speak on Companies Act for hours and hours. 1.5 hours is a very, very limited time, especially on the compliance part is concerned.
Right, ma'am. I was just going through the content.
Okay, this is something I really wanted to stress. Yeah, somebody has put this question. Needs to be filed every year, even after appointment for 5 years? No. The new Companies Act very clearly says this is the common error. Even when I take some audit from somebody, the auditor files say 5 years, and then the period chosen is 1 year. The appointment is for 5 years. It cannot be less than that. So the ADT 1 has to be filed for 5 years. The appointment is for 5 years. If the management or the company wants to, remove the auditor, then they have to follow the procedure given in the Act, and the auditor tenure is 5 years. Yes. ADT 1, it forces you to select a particular financial year. No, yes, you have to choose all the 5 years. There is a drop down for 5 years there. So you have to choose all the 5-year drop down there. In case company could not finalize the accounts, how to go ahead with the annual compliance. Sir, I said if the accounts are not finalized in time, please go to the registrar, request for a extension, and not finalizing in time is not a reason for the registrar to give an extension. Having said that, how do you manage is between you and the registrar. Give them an explanation and get the extension. Otherwise, even if the AGM is also not held, the forms have to be filed in time. That's why I said in one slide, the last date for holding AGM or 30 days or 60 days from the date of AGM. So if the AGM is not conducted, if the last date for conducting an AGM is 30th September, then AOC 4 has to be filed within 30 days from 30th September, and MGT 7 and 7A has to be filed within 60 days from 30th September. So that is where it is. The amount received as advance by the company for the supply of goods or provision of services not older than 365 days, not a deposit. Is this cumulative outstanding balance for more than 365 days, or this is 365 days advance in each? You have to justify why you are having cumulative advance. If advance is for executing a contract, if the contract is not executed, then why it is cumulative? In this spirit, I will say no, it has to be taken as cumulative advance. There could be another opinion which says it is okay, but I will take a conservative opinion and say it is cumulative advance. Whether a small company needs to file DIR 12 every year. So what is DIR 12? DIR 12 is for appointment and resignation. So if you have an additional director appointed by the board, the additional director appointment has to be ratified in the AGM and continued. So if it is continued, you will file a DIR 12. If it is not continued, then automatically, the resignation is being filed. Yeah. Because when you go to filing your any of the MCA forms, you could see somewhere the title of the director will come as additional director. It is not picking up as a normal director because his appointment is not ratified. DIR 12 confirming the ratification is not filed in the MCA portal. So the only way is to ratify the appointment in an AGM and file the DIR 12. If audited accounts are not ready, can they be adopted in the AGM and board given the power through the board meeting to adopt the audited accounts? It says audited accounts. So you are not fulfilling the provisions of law. It says the agenda for the AGM is adoption of audited accounts.
Any other questions do we have?
Okay.
Yeah, I think that's all we have in the queries. However, if you have any queries, you can definitely get back to us on the email, and we would be surely getting back with the report. And ma'am, on behalf of WIRC, ma'am, I would like to thank you for such an excellent presentation and the ideas you have presented in such an elegant manner. And thank you so much, ma'am, and for all the efforts in this. There's a lot of effort involved in making all these presentations. So thank you so much on behalf of our WIRC, and I would also like to thank all the participants for making this session more interesting. And also I would wish, since we have a day more left for the another day of the sessions, so wishing you all a very super energetic session tomorrow, and hope you will be as active as all of you were today. And
thank you very much.
Yeah. Thank you so much, ma'am. Thank you, Sanket.
Thank you.
Yes, thank you, Bhavna. Thank you, ma'am.